In 1949, a man named Benjamin Graham wrote a book. Warren Buffett, the most successful investor in human history, called it the best book on investing ever written. He has read it multiple times. He still recommends it to this day. This is not a book about getting rich quick. It is not about trading stocks or timing the market. It is about something far more rare and far more valuable: being intelligent with your money in a world designed to make you emotional about it. The Intelligent Investor will show you the difference between investing and speculation, and why most people who think they are doing one are actually doing the other. It will show you how to build a portfolio that survives every market crash, every recession, and every financial crisis, because it has already survived all of them. This book was written over 70 years ago. Every single principle in it still applies today. If this is the kind of content that adds real value to your life, subscribe before this video ends. Share it with someone who is about to make their first investment. This could be the most important hour of their financial life. All right, let us begin.
Chapter 1. Investment versus Speculation. Results to be expected by the intelligent investor. In this opening chapter, Benjamin Graham sets the foundation of his entire philosophy. He begins by addressing one of the most critical distinctions every investor must understand: the difference between investment and speculation. This chapter is not just about finance, it's about mindset. Graham believed that most of what passes as investing today is actually speculation in disguise. To him, the intelligent investor is someone who makes decisions based on analysis, discipline, and safety, while the speculator chases excitement, emotion, and quick profits. The core distinction: investment versus speculation. Graham defines an investment operation as one that, after thorough analysis, promises safety of principal and an adequate return. Anything that does not meet these criteria is speculation. Let's break this down. Thorough analysis means doing your homework, understanding a company's financial health, earnings power, and business model. Safety of principal means protecting your capital from permanent loss. Adequate return means realistic, moderate profits, not sky-high dreams. Graham warns that speculation isn't inherently evil. It only becomes dangerous when investors fail to recognize they're speculating. Most people, he says, think they're investing when they're simply gambling on market movements. He compares the speculative investor to a person trying to predict the direction of the wind, while the intelligent investor focuses on building a solid ship that can weather any storm. The market's seductive trap. During Graham's lifetime, and still true today, investors are constantly seduced by the market's fluctuations. Rising prices create euphoria, falling prices trigger panic. The emotional roller coaster causes most people to buy high and sell low. Graham emphasizes that the intelligent investor must remain emotionally detached from these swings. He says, "The investor's chief problem, and even his worst enemy, is likely to be himself." This insight is timeless. The market's behavior reflects collective human emotion. Prices don't always reflect value, they reflect psychology. To illustrate this, Graham introduces one of his most famous metaphors, Mr. Market, which he explores further in later chapters. Imagine Mr. Market as a moody business partner who shows up every day offering to buy or sell shares at different prices. Some days he's euphoric and offers ridiculous sums. Other days he's depressed and willing to sell for almost nothing. The intelligent investor does not let Mr. Market's mood dictate his decisions. Instead, he uses Mr. Market's irrational behavior to his advantage, buying when prices are low and selling when prices are high. Lessons from market history. Graham was a student of history, and he urges every investor to study the market's past. He cites examples of speculative booms and crashes, from the roaring 1920s to the devastating crash of 1929. Each boom was driven by optimism, people believing that this time is different. But every time the market corrected, punishing those who ignored the difference between price and value. He reminds us that even when stock prices are soaring, their underlying value doesn't change overnight. Intelligent investors remain skeptical of euphoria and cautious during market bubbles. A modern-day example of this principle can be seen in the dot-com bubble of the late 1990s, or the crypto boom, where investors poured money into assets with little understanding, driven by the fear of missing out. When reality set in, most of those speculative gains vanished. Graham's warning? Don't let excitement or fear dictate your investment moves. Rationality must always lead emotion.
The role of the intelligent investor. So, what does the intelligent investor actually do? Graham says they focus on three things: analyzing businesses and their intrinsic value, ensuring a margin of safety before investing, controlling emotions regardless of market conditions. He compares intelligent investing to being an owner of a business, not a trader of paper stocks. You're not buying numbers on a screen, you're buying ownership in a real company with earnings, assets, and people behind it. He emphasizes that the stock market is there to serve you, not instruct you. Your decisions should come from logic, not market noise. A powerful way to put this into practice is to create an investment policy, a written set of principles guiding when and how you'll invest. This helps prevent emotional reactions during market turbulence. Speculation, the necessary evil. Interestingly, Graham doesn't condemn speculation entirely. He admits that a small, controlled amount of speculation can be acceptable, but only under one condition. The investor must separate it clearly from their serious investments. He suggests setting aside a small portion, say 10% of your portfolio, for speculative ventures like startups or short-term trades. The key is to treat it as entertainment, not your primary wealth-building strategy. This advice is more relevant today than ever, in an age where meme stocks, cryptocurrencies, and get-rich-quick schemes dominate social media. Intelligent investors can explore these, but never let them compromise their long-term financial foundation. The mindset of the intelligent investor. At the core of Graham's philosophy is temperament. The intelligent investor is not necessarily the smartest person in the room, but the most disciplined. He or she is patient, willing to wait for the right opportunity. Rational, guided by data and analysis. Humble, acknowledging that markets can be unpredictable. Courageous, willing to go against the crowd when logic demands it. In other words, the intelligent investor doesn't chase the market. They let value and logic guide their actions. Practical application. Becoming the intelligent investor. Let's bring Graham's philosophy into daily life. Adopt a long-term view. Don't think in weeks or months. Think in years or decades. True wealth is built over time. Avoid market noise. Turn off the constant news updates and predictions. Instead, focus on the intrinsic value of what you own. Set clear goals. Know why you're investing. For financial independence, retirement, or security. And let those goals guide your strategy. Use the margin of safety. Always buy with a cushion, meaning the price you pay should be below the stock's intrinsic value. Keep emotions in check. Fear and greed are powerful forces. Awareness of these emotions is the first step towards mastering them. Closing thoughts on Chapter 1. In this first chapter, Graham gives us the essence of intelligent investing. Think long-term, be analytical, and control your emotions. He reminds us that the stock market will always fluctuate, and short-term gains will tempt you. But lasting success comes to those who focus on value, discipline, and patience. As Graham wisely wrote, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." So, The choice is yours. You can follow the crowd and speculate, or stand apart, think independently, and become a true intelligent investor.
Chapter 2. The Investor and Inflation. In this second chapter, Benjamin Graham turns his sharp focus to a force that quietly erodes wealth over time: inflation. Unlike market crashes that strike suddenly, inflation is a slow, silent thief, stealing purchasing power year after year. Graham warns that even the most carefully built portfolio can lose its real value if the investor fails to understand how inflation works and how to protect against it. The reality of inflation. Graham begins with a simple truth: $1 today won't buy as much tomorrow. Over time, the value of money declines, meaning that even if your nominal wealth increases, your real wealth, what your money can actually buy, may shrink. For example, suppose you earn a 5% return on your investments in a year when inflation is 6%. You haven't gained, you've actually lost 1% in purchasing power. In Graham's words, inflation is the investor's permanent enemy, and ignoring it is one of the biggest mistakes a person can make. Historical context: the persistent thief. Graham wrote The Intelligent Investor in the mid-20th century, a period marked by post-war inflation. Many at that time believed inflation was a temporary phenomenon. But Graham disagreed. He had seen history repeat itself. Wars, economic expansion, and political decisions consistently led to rising prices over the long term. To make his point, he looked back over several decades of U.S. data. He observed that between 1900 and 1970, the dollar had lost more than half its purchasing power. And today, decades later, that truth has multiplied many times over. The lesson is clear: inflation is not an occasional visitor, it's a constant companion. The investor's dilemma. The natural question is, how should investors respond? Graham points out that many investors assume that owning stocks is the best protection against inflation, because companies can raise prices, boost revenues, and grow profits. This belief has truth in it, but Graham cautions that it's not foolproof. Stocks, like all assets, are subject to emotional overvaluation and market corrections. They can provide long-term inflation protection, but they also bring volatility and short-term risk. He reminds us that there were long stretches in history, such as the Great Depression and the stagflation of the 1970s, when stock returns failed to outpace inflation for years. So relying on stocks blindly as an inflation cure is misguided. Lessons on understanding real returns. Graham's timeless wisdom lies in his insistence on differentiating between nominal returns and real returns. Nominal return is the percentage gain you see on paper, like 8% per year. Real return is what remains after inflation. If inflation runs at 4% and your nominal return is 8%, your real return is only 4%. This simple calculation is often overlooked by investors who feel happy about rising portfolio values but forget to measure what those gains mean in real terms. A practical example. Imagine your grandparents bought government bonds paying 5% interest in 1960. At the time, that seemed safe and steady. But when inflation averaged 4%, their real gain was just 1%, barely enough to maintain purchasing power. Over decades, those safe bonds lost real value. This is why Graham stresses that investors must focus not on avoiding risk, but on managing it intelligently. And inflation is one of the greatest long-term risks of all.
The illusion of safety in bonds. One of Graham's most insightful and counterintuitive teachings is that bonds are not truly safe in an inflationary world. He calls them deceptively safe. Bonds promise a fixed return, which gives a false sense of security. But when inflation rises, those fixed payments buy less and less each year. For example, suppose you buy a 10-year government bond that pays 4% interest. If inflation averages 5% during that period, you've effectively lost money because your purchasing power has declined. Graham uses this to warn conservative investors who rely heavily on bonds for safety. In reality, their portfolios might be quietly shrinking in value. He isn't saying investors should avoid bonds completely, only that they should recognize the hidden risk and maintain balance. Stocks as partial protection. While no investment is a perfect hedge against inflation, Graham acknowledges that common stocks have historically outperformed other assets in the long run. Why? Because companies can adjust to inflation by raising prices, reducing costs, and passing some of the burden on to consumers. In effect, ownership in productive businesses allows investors to benefit from rising economic activity. However, Graham again issues a warning. Stock markets are unpredictable. In the short term, they may underperform, and during bubbles, they can vastly overvalue the future. Thus, the intelligent investor must hold stocks for the long term, not as speculative vehicles, but as ownership stakes in real enterprises. A modern example. During the 1970s, inflation soared into double digits and stock prices plunged. But by the 1980s and 1990s, the companies that survived and adapted delivered tremendous long-term gains. Investors who held their positions through the storm came out far ahead of those who panicked and sold. The lesson? Patience and perspective are essential to enduring inflationary periods. Real assets and diversification. Graham also briefly discusses alternative stores of value. Real assets such as real estate, commodities, and ownership in businesses often provide protection against inflation because their value tends to rise as prices increase. In modern times, we can add index funds, REITs, real estate investment trusts, and inflation-protected securities like TIPS as tools to maintain real wealth. The intelligent investor doesn't bet everything on one asset class. Instead, they create a balanced portfolio, one that can withstand both inflationary and deflationary environments. The intelligent investor's approach to inflation. Graham's message in this chapter is not one of fear, but of preparation. Inflation cannot be avoided, but it can be outsmarted. He offers several practical principles. Don't overreact to short-term inflation trends. Inflation data fluctuates. Short-term changes shouldn't cause radical shifts in your portfolio. Diversify intelligently. Hold a mix of stocks and high-quality bonds or other inflation-protected assets so that you benefit in multiple economic environments. Focus on real value, not price. A business that produces essential goods or services, like utilities, food, or energy, often maintains earning power during inflation. Be patient and rational. Inflationary fears often cause panic. The intelligent investor uses logic, not headlines, to make decisions. Invest in yourself. Graham also implies that one of the best hedges against inflation is increasing your own earning power through skills, knowledge, and adaptability. Modern reflections. If Graham were alive today, he would likely emphasize that the digital economy adds new layers to inflation management. With global interconnectedness, central bank policies, and technology-driven deflation, the future of inflation is complex, but his principles remain timeless. Focus on fundamentals, protect your purchasing power, and think long-term. For example, investors today use tools like TIPS, index funds, and low-cost ETFs to apply Graham's teachings. These instruments allow everyday people to stay diversified and inflation-aware without falling into speculation. Closing thoughts on Chapter 2. Chapter 2 of The Intelligent Investor teaches one of the most important lessons in finance. It's not what you earn, it's what you keep after inflation that matters. Graham's wisdom reminds us that true wealth isn't about numbers on a screen. It's about maintaining and growing real purchasing power over time. He closes with a sobering truth. The investor cannot afford to ignore the destructive power of inflation. It is the invisible tax that affects everyone, but only the intelligent investor prepares for it. So, as you continue your journey to becoming a wise investor, remember, inflation is inevitable, but financial intelligence is your shield. Stay patient, stay rational, and focus on value that endures.
Chapter 3. A Century of Stock Market History, the Level of Stock Prices in Early 1972. In this chapter, Benjamin Graham gives us a panoramic view of the stock market across nearly a century. His goal isn't to predict the market's future, but to show how understanding its past can protect us from dangerous illusions. Those who do not remember the past, Graham reminds us, are condemned to repeat it. 1. The market's roller coaster. Lessons from history. Graham opens with an exploration of the stock market from the early 1900s to 1972, a dramatic ups and downs. He emphasizes that markets are cyclical by nature, swinging between overvaluation and undervaluation. From the boom of the 1920s to the crash of 1929, and from the post-war optimism of the 1950s to the stagflation fears of the 1970s, Graham illustrates how human behavior, fear, greed, and herd mentality has always driven prices far beyond reason. In 1929, for example, stocks were trading at an average price-to-earnings ratio of nearly 30, signaling euphoric overconfidence. Investors believed prosperity would never end. But by 1932, after the crash, that same market had collapsed by nearly 90%, a brutal reminder that valuation always matters. 2. The Great Depression and its aftermath. Graham himself lived through the Great Depression, and his perspective comes from painful experience. The collapse of 1929 was not just a financial event. It was emotional and psychological reckoning for investors. He explains that before the crash, the market's valuation levels were entirely detached from underlying earnings and dividends. When the bubble burst, even blue-chip companies like U.S. Steel and General Motors lost most of their value. However, Graham noticed something remarkable. Investors who bought during the depths of despair, when everyone else was terrified, achieved extraordinary long-term returns. This historical lesson gave birth to one of his timeless principles. The intelligent investor is a realist who sells to optimists and buys from pessimists. 3. The recovery and the bull markets. The 1940s and 1950s brought renewed optimism. After the Second World War, the U.S. economy entered a period of massive expansion, and the stock market followed. Between 1949 and 1968, the Dow Jones Industrial Average rose from 160 to over 1,000, a six-fold increase. Corporate earnings grew, consumer confidence soared, and investing in stocks became mainstream. Yet, Graham warned that this growth, while based on real economic progress, also carried seeds of overconfidence. He observed that by 1968 to 1972, valuations again started to stretch. Investors began assuming that the good times would last forever, a dangerous assumption in any era. The key lesson? Bull markets breed arrogance, and arrogance blinds investors to risk. 4. How to measure market levels, Graham's analytical lens. Graham, ever the rational thinker, introduces analytical tools to determine whether the market is overvalued or undervalued. He focuses on three primary measures: earnings trends, long-term corporate earnings growth compared to stock prices; dividend yields, the income investors receive as a percentage of stock prices; and interest rates, the relationship between bond yields and stock earnings yields. He explains that when stock earnings yields, the inverse of the P/E ratio, fall below bond yields, it's a red flag. It means investors are paying too much for stocks relative to the risk-free returns available in bonds. For example, in early 1972, the average stock was trading at a P/E ratio of 18, while long-term bonds were yielding about 7%. Graham suggested that the market was overpriced and that future returns were likely to disappoint. His advice to investors: the future of the market is uncertain, but the value of your discipline is not.
5. The investor's perspective, timing versus temperament. One of Graham's sharpest warnings in this chapter is against market timing. He believed it was nearly impossible for anyone, no matter how skilled, to consistently predict short-term market movements. Instead,
he emphasized temperament over timing. The intelligent investor should be patient, disciplined, and skeptical of market euphoria. He should base decisions on intrinsic value, not speculation or forecasts. Graham points out that market history is littered with brilliant people who tried to outsmart it and failed. What separates winners from losers isn't intellect, it's emotional control. 6. The market as a reflection of human nature. Graham's review of a century of stock market history reveals one simple truth. The market is not rational, it is emotional. Every era repeats the same pattern. Hope leads to euphoria, euphoria turns into greed, greed leads to collapse, and collapse breeds fear, which eventually gives way to renewed hope. He compares this cycle to a pendulum that swings between unsustainable optimism and unjustified pessimism. The intelligent investor's task is not to predict the swing, but to stay calm while others lose their balance. This is where Graham introduces his now famous concept of Mr. Market, a metaphor for the market's mood swings. Each day, Mr. Market offers to buy or sell your shares at different prices based on his emotions. Your job is to take advantage of his irrationality, not to imitate it. 7. Practical applications. How to use market history. Let's translate Graham's wisdom into actionable steps. A. Study valuations before investing. Don't buy stocks simply because they've been going up. Analyze whether current prices make sense compared to earnings, dividends, and interest rates. B. Avoid herd mentality. When everyone around you is euphoric, it's usually a warning sign. As Warren Buffett, Graham's most famous student, later said, be fearful when others are greedy, and greedy when others are fearful. C. Keep long-term perspective. Short-term declines are inevitable. The key is to focus on value and hold through volatility rather than reacting emotionally. D. Build a margin of safety. Always leave room for error. Even if your analysis is sound, the future is uncertain. Buying with a margin of safety ensures protection against market downturns. 8. Graham's final message in this chapter. By the early 1970s, Graham saw that the market was overvalued, yet he didn't advise investors to panic or sell everything. Instead, he urged balance and discipline. He suggested that defensive investors, those seeking stability, should hold more in bonds and fewer stocks during periods of high valuation. Conversely, enterprising investors could still find undervalued opportunities if they looked carefully. The essence of Graham's wisdom can be summed up in this quote: "The investor's chief problem, and even his worst enemy, is likely to be himself." Bringing it all together, lessons for today. Although Graham wrote this analysis over 50 years ago, his insights remain strikingly relevant in our world of crypto booms, meme stocks, and speculative buggles. Markets will always fluctuate. The names may change, Tesla, Bitcoin, AI stocks, but the underlying psychology is eternal. The intelligent investor studies history not to predict, but to prepare, because while the future is uncertain, human behavior is remarkably consistent. 10. Practical takeaway for Audio Growth Library listeners. Learn from past cycles. Market highs and lows repeat. Don't chase trends, understand them. Respect valuations. A great company isn't always a great investment if the price is too high. Focus on discipline. Investing is more about managing emotions than picking stocks. Be a long-term realist. Build a strategy that can survive both booms and busts. That concludes Chapter 3, A Century of Stock Market History from The Intelligent Investor by Benjamin Graham. In the next chapter, we'll explore how Graham defines the difference between defensive and enterprising investors and how you can decide which one you are. Stay tuned for more wisdom on Audio Growth Library, where timeless financial intelligence meets practical guidance.
Chapter 4, General Portfolio Policy, The Defensive Investor. In Chapter 4 of The Intelligent Investor, Benjamin Graham introduces one of the most important distinctions in all of investing, the difference between the defensive investor and the enterprising investor. This chapter is a foundational one. It defines how ordinary people can grow and protect their wealth without falling into the traps of speculation or emotional decision-making. It's not about getting rich overnight. It's about getting rich surely, safely, and sanely. Let's explore Graham's timeless roadmap for the defensive investor, the type of investor who wants financial growth with minimal risk and effort. 1. Who is the defensive investor? Graham defines the defensive investor as someone who values safety and peace of mind over high returns, does not have the time or interest to study individual investments deeply, and prefers a simple, disciplined approach rather than constant market activity. This investor, in modern terms, might be a busy professional, a family person, or anyone who prefers to set it and forget it. Graham writes, "The defensive investor's chief aim is to avoid serious mistakes or losses, not to achieve brilliant successes." In other words, success in investing doesn't come from extraordinary intelligence. It comes from avoiding stupidity. 2. The importance of defensive investing. Graham makes an honest admission: most people are not suited for active investing. The reason is simple: emotion. People chase rising stocks, panic when markets fall, and make decisions driven by greed or fear. The defensive investor's greatest strength is emotional stability, the discipline to stay steady when others are impulsive. Graham's advice is revolutionary even today. The essence of investment management is the management of risks, not the management of returns. He believed that protecting yourself from major losses is more important than chasing big gains. 3. The two basic components, stocks and bonds. Graham proposes that every defensive portfolio should contain a mix of stocks and bonds. Why? Because each asset class behaves differently across economic cycles. Stocks provide growth and protect against inflation. Bonds provide income and stability. The right balance between these two gives both protection and growth. Graham's recommended allocation is elegantly simple. The investor should divide his funds equally between bonds and common stocks, 50% to each. However, he allows some flexibility. If stocks are very high, overvalued, reduce them to 25% of the portfolio. If stocks are very low, undervalued, increase them to 75%. This approach prevents emotional market timing. It's rational rebalancing based on valuation. 4. Why simplicity wins. Graham repeatedly stresses simplicity. Most investors are tempted by complex strategies, exotic funds, or stock-picking schemes, but Graham argues that simplicity beats sophistication, especially for the defensive investor. He compares investing to driving a car. The more you fiddle with the controls, the higher your chance of an accident. The calm, consistent driver reaches the destination safely. That's why Graham recommends sticking to high-quality investments rather than chasing hot tips or speculative trends. 5. The defensive investor's stock selection criteria. When it comes to choosing stocks, Graham doesn't expect defensive investors to analyze balance sheets or industry cycles. Instead, he gives a simple, mechanical checklist for selecting reliable companies. Adequate size. Avoid small, risky companies. Look for large, established firms with stable revenues. Strong financial condition. Companies should have a current ratio, that is, assets versus liabilities, of at least 2 to 1 and manageable debt levels. Consistent earnings. The company must have earned profits for at least the past 10 years. Uninterrupted dividends. A steady dividend record for at least 20 years indicates financial stability and shareholder discipline. Earnings per share should show at least a modest increase over the past decade. Moderate price-to-earnings ratio. Graham advises a P/E ratio below 15 times average earnings over the past 3 years. Moderate price-to-book value. The price should not exceed 1.5 times the book value of the company. These criteria may sound conservative, but that's the point. They protect you from overpaying for excitement and hype. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks.
6. What about bonds? Graham recommends the defensive investor hold high-grade bonds or U.S. savings bonds, those backed by the government or strong corporations. He warns against junk bonds or speculative debt instruments that promise high returns. The extra yield, he says, is never worth the added risk. He also suggests diversifying between long-term and short-term maturities to balance yield and flexibility. Today, this translates into investing in high-quality bond ETFs or government securities. 7. The role of index funds. Graham's idea before they existed. Although index funds didn't exist in Graham's time, his philosophy paved the way for them. He advised that most defensive investors should not try to pick individual stocks. Instead, they should buy a broad basket of high-quality companies. In modern terms, this means investing in low-cost index funds like the S&P 500 or total stock market funds. As he put it, by owning a diversified group of leading companies, the investor's results will approximate those of the market average with less effort and fewer mistakes. That's exactly what index investing achieves today: steady, market-matching returns with minimal stress. 8. The power of rebalancing. Every year, the defensive investor should rebalance their portfolio back to their target allocation. For example, 50% stocks and 50% bonds. Adjust only when markets move drastically. This discipline forces you to buy low and sell high automatically. You don't need forecasts or gut feelings, just consistent rebalancing. This practice is the backbone of long-term wealth accumulation and capital preservation. 9. Emotional discipline, the real secret. Graham emphasizes that investing is less about intelligence and more about temperament. Markets will always fluctuate. The defensive investor's greatest tool is emotional resilience, staying calm when others panic. He notes, the investor's chief advantage is not in superior knowledge, but in superior character. This principle is timeless. Whether it's the 1970s oil crisis or today's cryptocurrency volatility, the calm investor always wins over the reactive one. 10. Practical applications. How to be a defensive investor today. Let's break down Graham's guidance into clear modern steps for listeners of Audio Growth Library. Adopt the 50-50 rule. Keep half your investments in stocks, like index funds, and half in high-quality bonds. Adjust only when markets move drastically. Stick to large, stable companies. Focus on firms with long histories of profit, dividends, and conservative management. Rebalance annually. Bring your portfolio back to your chosen mix to control risk and lock in gains. Ignore the noise. Financial media thrives on fear and hype. Don't let headlines dictate your strategy. Invest regularly. Practice dollar-cost averaging, investing a fixed amount every month regardless of market conditions. It builds wealth through consistency. Stay patient. Wealth is built in decades, not days. The defensive investor's reward is not speed, it's certainty and serenity. 11. Graham's final message, safety is success. Graham closes the chapter with a reassuring truth. The defensive investor will never achieve spectacular returns, but will also never face ruin. Over long periods, this steady approach often outperforms those who chase fast money and lose everything in a downturn. He writes, the defensive investor's results may appear modest, but they are likely to be both adequate and dependable. And that's the core philosophy of the intelligent investor. Investing is not about beating the market. It's about beating your own emotions and preserving capital through wisdom and discipline. 12. Key takeaways for Audio Growth Library listeners. Focus on protection before profit. Keep investing simple and structured. Build a balanced portfolio of stocks and bonds. Rebalance and stay consistent through market cycles. Let time and discipline compound your wealth, not speculation. That concludes Chapter 4, General Portfolio Policy, The Defensive Investor, from The Intelligent Investor by Benjamin Graham. In the next chapter, we'll explore the enterprising investor, the one who's willing to dig deeper, take calculated risks, and seek slightly higher returns while still following Graham's principles. Stay tuned with Audio Growth Library, where financial wisdom becomes practical power.
Chapter 5. The Defensive Investor and Common Stocks. In Chapter 5 of The Intelligent Investor, Benjamin Graham continues to guide the defensive investor, but this time he zooms in on a crucial question. How should a defensive investor approach common stocks? Graham believed that stocks are essential for long-term growth, but only when approached with patience, discipline, and realism. This chapter is about learning how to invest in the stock market without being consumed by it, how to let your money work for you while keeping your emotions under control.
Let's dive into Graham's timeless lessons for ordinary investors who want to benefit from stocks without gambling on them. 1. Why stocks matter even for the defensive investor. Graham begins by explaining that avoiding stocks completely is a mistake. While bonds offer safety and fixed income, they're vulnerable to inflation, which erodes purchasing power over time. Stocks, on the other hand, represent ownership in real businesses. As companies grow and raise prices, their earnings and dividends rise, helping investors stay ahead of inflation. It is the stock component of the portfolio that provides the real protection against inflation. For Graham, a balanced mix of stocks and bonds gives the defensive investor both security and growth, safety in bonds, and progress in stocks. 2. The problem of investor psychology. Before explaining how to select stocks, Graham warns against the biggest enemy, our emotions. Most people are not defeated by poor choices of companies. They are defeated by their reactions to market fluctuations. When prices go up, they get greedy and buy more. When prices fall, they get scared and sell. This behavior guarantees disappointment. Graham writes, "The investor's chief problem, and even his worst enemy, is likely to be himself." He encourages investors to view stock ownership like owning part of a business. If the price fluctuates, it's not a reason to panic. It's an opportunity to buy more of a good company at a discount, or simply stay patient until value is realized. 4. What kind of stocks should the defensive investor own? For the defensive investor, Graham suggests focusing on high-quality, established companies. These are firms with strong balance sheets, consistent earnings, and a long record of paying dividends. Here are Graham's selection principles for the defensive investor's stock portfolio. Adequate diversification. Hold between 10 to 30 stocks across different industries. This reduces risk from any single company failure. Large, prominent, and conservatively financed firms. Stick with companies that are leaders in their field and have low debt. Long record of dividends. The company should have paid dividends for at least the past 20 years without interruption. Dividends demonstrate financial health and management discipline. Moderate price ratios. Avoid overpaying. Graham recommends a P/E ratio below 15, price not more than 15 times average earnings of the past 3 years. A price-to-book ratio not exceeding 1.5 times book value. These rules are designed to eliminate hype, emotion, and speculation, leaving only steady, time-tested businesses. 5. The defensive investor's approach, simplicity and discipline. Graham repeatedly stresses simplicity. The defensive investor does not need to study financial reports or chase stock trends. Instead, he can buy a representative cross-section of leading companies or use index funds, a modern option that perfectly fits Graham's philosophy. In fact, if index funds had existed in Graham's day, he would likely have recommended them as the perfect tool for the defensive investor. They offer instant diversification, low costs, and reliable performance that matches the overall market. By owning a diversified group of leading companies, the investor's results will approximate those of the market average, with less effort and fewer mistakes. In short, the less you do, the better your results, if you choose wisely and stay disciplined.
6. Dollar cost averaging, a powerful tool. To help defensive investors avoid emotional timing mistakes, Graham introduces the concept of dollar cost averaging, DCA, a strategy still used by successful investors worldwide. Here's how it works. You invest a fixed amount of money at regular intervals, regardless of whether prices are high or low. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, your average cost evens out, and you automatically buy more when stocks are cheap, the ideal behavior. This method removes emotion, encourages discipline, and ensures consistent growth over decades. For example, imagine investing $500 every month in a broad index fund for 20 years. Without timing the market, you would build a powerful compounding machine that grows regardless of short-term market noise. Graham would call this approach a mechanical, unemotional way to invest wisely. 7. Dividends, the defensive investor's friend. Graham viewed dividends as an anchor of stability. They provide regular income and discourage investors from making rash moves based on price changes. He recommends favoring companies that have a long history of paying and maintaining dividends because it shows management confidence, it provides psychological comfort in market downturns, and it ensures investors are rewarded even if prices stagnate. He reminds readers that dividends represent real cash returns, unlike speculative capital gains, which depend on market moods. Modern investors can apply this by choosing dividend-focused ETFs or blue-chip companies with decades of consistent payouts, such as Johnson & Johnson, Procter & Gamble, or Coca-Cola. 8. Graham's warning against forecasts. Graham firmly rejects predictions about market direction, interest rates, or economic trends. He believed that no one can consistently predict market movements, and trying to do so only leads to overtrading and emotional mistakes. The investor's chief protection lies in his refusal to make forecasts or to act upon others' forecasts. For defensive investors, the best approach is consistency over prediction. Invest regularly, stay diversified, and ignore the chatter. This advice, though written over half a century ago, is still ignored by millions who chase news headlines instead of following timeless principles. 9. Practical portfolio setup for the defensive investor. Here's how Graham would structure a modern portfolio for today's defensive investor based on his timeless rules. 50% stocks, 50% bonds. Rebalance annually. Use index funds, such as S&P 500 ETFs for stocks and U.S. Treasury or high-grade bond ETFs. Invest monthly. DCA method. Automatic, consistent investing reduces stress. Hold for the long term. Don't trade frequently. Think in decades. Reinvest dividends. Let your returns compound over time. This formula may sound too simple to be effective, but history has proven it to outperform the majority of actively managed portfolios. 10. The true meaning of being defensive. Being defensive doesn't mean being timid or passive. It means being rational, disciplined, and protective of your capital. It means you invest with a plan, not with emotion. As Graham beautifully puts it, to be an intelligent investor is to be realistic, not hopeful. The defensive investor accepts moderate, reliable returns, knowing that over decades, this approach leads to financial freedom with far less anxiety. 11. Key takeaways for Audio Growth Library listeners. Let's summarize Graham's golden lessons from Chapter 5. Own a diversified mix of high-quality, dividend-paying stocks. Avoid overpaying for popular or overhyped companies. Invest regularly through dollar-cost averaging. Use index funds if you don't want to pick stocks. Rebalance yearly to maintain your target allocation. Stay calm. Market fluctuations are opportunities, not threats. The defensive investor's secret weapon is not market knowledge, but emotional control. Final thoughts. In Graham's words, the defensive investor can do no better than to adopt a simple, sound investment policy and stick to it. This is the heart of intelligent investing: steady, patient, and principled growth. By following this method, you don't just protect your money, you also protect your peace of mind.
Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. In this chapter, Benjamin Graham focuses on what the enterprising investor should avoid, rather than what he should do. It's titled Portfolio Policy for the Enterprising Investor, the Negative Approach, and it's all about steering clear of pitfalls that destroy wealth, those seductive traps that look like opportunity but are actually speculation dressed as investment. Let's break this down into key insights, stories, and practical steps so you can apply these timeless lessons to your own investing journey. 1. The essence of the negative approach. In this chapter, Graham argues that being a successful, enterprising investor doesn't mean aggressively chasing every potential gain. It means carefully avoiding foolish risks. The best investors often succeed not by doing more, but by avoiding stupidity. He states that the essence of investment management is the management of risks, not the management of returns. This mindset flips the modern investing world upside down. Today, people chase 10x stocks, meme coins, or high-growth tech companies. But Graham reminds us that the enterprising investor's advantage is not in predicting the next big thing. It's in understanding what not to do. He insists that the negative approach, avoiding dangerous stocks and unsound companies, is a far more reliable way to protect and grow wealth over the long term. 2. the danger of new issues and IPOs. One of Graham's strongest warnings is against new issues, which we now call IPOs or initial public offerings. He observes that IPOs are often launched during bull markets, when optimism is high and investors are eager to buy shares. Companies and their underwriters take advantage of this enthusiasm to sell shares at inflated prices. He writes, "New issues have special salesmanship behind them, which nearly always makes them a bad buy for the public." Example, the 1920s and the tech bubble. During the 1920s, just before the Great Depression, hundreds of companies went public, many with no profits and vague business plans. Investors rushed in out of greed, only to be wiped out when the market crashed. Similarly, during the dot-com bubble of the late 1990s, countless tech companies launched IPOs with zero earnings. Stocks like Pets.com skyrocketed at first, but soon collapsed, leaving investors with massive losses. The same pattern repeated in recent years, with companies like WeWork or certain cryptocurrency platforms, all showing that hype-driven investments often end in disappointment. Practical tip: avoid buying into hype. If a company's main appeal is excitement or novelty, rather than earnings and a proven record, step back. Remember Graham's rule: the time to buy new issues is when nobody wants them. 3. Avoiding hot industries and fads. Another trap Graham warns against is chasing hot industries. Whether it's railroads in the 19th century, dot-coms in the 1990s, or electric vehicles and AI stocks today, when everyone is talking about it, the easy money has already been made. He points out that investors often equate innovation with profitability, but innovation doesn't guarantee sustainable earnings. In fact, history shows that the pioneers of a new industry rarely remain its long-term winners. Story: the airline industry trap. Graham uses the airline industry as an example. Air travel was revolutionary, yet airlines as businesses have often struggled to make profits. Despite being one of the most transformative industries of the 20th century, airlines went bankrupt repeatedly because of high costs and fierce competition. This teaches us that even great products don't always make great stocks. Practical tip: if you hear everyone talking about a can't-miss opportunity, that's your signal to pause. Instead, look for solid, boring businesses with consistent cash flow and proven management, companies that may not be exciting, but are reliably profitable. 4. Don't chase high-growth stocks. Graham calls out the dangerous belief in the growth stock myth, the idea that paying a high price for a rapidly growing company guarantees big returns. While growth companies can be successful, Graham warns that overpaying for growth leads to disaster. Investors often price in unrealistic future expectations, and when those expectations aren't met, stock prices collapse. Example, the Nifty 50. In the 1960s and 70s, the Nifty 50, a group of blue-chip growth stocks like IBM, Coca-Cola, and Polaroid, were considered sure things. Investors paid outrageous prices for them, assuming they could never fall. But when the market turned in the 1970s, these can't-lose stocks plunged by 50% or more. Graham teaches that the price you pay matters more than the company's potential. Even a wonderful company can be a poor investment if you buy it at the wrong price.
5. The illusion of market timing. One of the most enduring lessons in this chapter is Graham's rejection of market timing, the attempt to predict when the market will rise or fall. He notes that even professionals fail at this. The temptation to wait for the dip or get in before it rises leads most investors to buy high and sell low. Graham's philosophy is to invest consistently and stay disciplined regardless of market noise. The enterprising investor's strength lies not in predicting the market, but in analyzing individual businesses and maintaining patience. Example: the Great Crash of 1929. Before the crash, many investors believed they could get out before prices fell. They couldn't. Those who stayed disciplined and focused on value eventually recovered, while speculators were wiped out. Practical tip: build a strategy and stick to it. Whether it's monthly investing or periodic rebalancing, consistency beats prediction. 6. Beware of expert advice and insider information.
Graham mocks the obsession with stock tips, financial news, and supposed insider secrets. He points out that tips and forecasts are designed to sell, not to inform. Even Wall Street analysts, he argues, are influenced by bias and overconfidence. Many investors lose money because they blindly follow others instead of doing their own homework. Practical tip: before buying any investment, ask yourself, do I understand this business? Can I explain why it's undervalued? If the answer is no, don't buy. As Warren Buffett later said, the stock market is designed to transfer money from the active to the patient. 7. Building the enterprising mindset. The essence of this chapter is psychological. Graham teaches that the best investors cultivate discipline, skepticism, and independence. The enterprising investor doesn't seek excitement, he seeks consistency. He doesn't react to headlines, he responds to facts. He doesn't chase fads, he hunts for value. He sums this up by saying, to achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. In other words, you don't need brilliance to succeed. You need character. 8. Practical application. How to apply the negative approach. Here's how you can use Graham's lessons in real life. Avoid IPOs and hype-driven markets. Wait until the excitement fades and fundamentals are clear. Ignore hot industries. Focus on stable companies with proven records. Don't overpay for growth. Always demand a margin of safety. Buy at a discount to intrinsic value. Resist market timing. Stay invested, stay rational, and think long-term. Be skeptical of tips and news. Verify every claim with data, not emotion. Adopt a calm temperament. Successful investing is less about IQ and more about emotional control. Final thoughts. In Chapter 6, Benjamin Graham gives us a priceless roadmap for what not to do. He shows that avoiding mistakes, not chasing perfection, is the real key to building wealth. The enterprising investor doesn't need to be aggressive or impulsive. Instead, he needs to be cautious, informed, and patient. When you learn to resist the lure of speculation, you gain something more powerful than money: peace of mind.
Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. In the previous chapter, Benjamin Graham guided us through the negative side of portfolio management, what the intelligent investor should avoid. Now, in Chapter 7, we turn to the positive side, what the enterprising investor should actually do to achieve superior returns while maintaining safety and discipline. This chapter marks a critical turning point in the book because Graham moves from caution to construction, from what not to do to how to do it wisely. Let's explore the key principles, stories, and practical strategies that can transform your approach to investing. 1. Who is the enterprising investor? Before laying out specific strategies, Graham defines who the enterprising investor really is. Unlike the defensive investor, who prefers safety and simplicity, the enterprising investor is active, analytical, and willing to put in the work. He doesn't speculate, but he's willing to dig deeper, researching balance sheets, understanding company fundamentals, and seeking opportunities others overlook. Graham writes, "The enterprising investor must devote a fair amount of his attention and effort to becoming familiar with the companies whose securities he contemplates buying." This type of investor is not driven by luck or stock tips. He is driven by effort, knowledge, and discipline. Practical tip. If you're not ready to spend several hours a week studying markets, companies, and financial statements, stick to the defensive path. But if you have the curiosity and patience to analyze, you can take the enterprising route and potentially outperform the average investor. 2. The core idea. Finding value others miss. The enterprising investor's main goal, Graham says, is to find undervalued securities. companies whose market price is less than their intrinsic value. This idea of value investing is the beating heart of Graham's philosophy. It's not about timing or predicting, but buying a dollar's worth of value for 70 cents or less. He insists that the margin of safety, the difference between price and true value, is what protects the investor from risk. Example: imagine a stock trading at $50, but after analysis, you estimate the company's true worth at $80. That $30 difference is your margin of safety. Even if your estimate is imperfect, you have room for error. By consistently applying this principle, you reduce risk and increase potential returns, a win-win formula that has stood the test of time. 3. 4 core strategies for the enterprising investor. Graham suggests several areas where enterprising investors can focus their efforts to find value and opportunity. Let's break these down. A. Buying in low markets and selling in high ones. Graham warns against trying to time the market daily or weekly, but he does suggest that the enterprising investor can adjust his portfolio according to general market conditions. When markets are low and pessimism rules, buy quality stocks at bargain prices. When markets are euphoric and prices are excessive, sell or hold cash. He emphasizes patience. The enterprising investor profits by waiting, not by rushing. Example: in the early 1980s, when inflation was high and stocks were deeply undervalued, investors who bought sound companies made extraordinary gains over the next decade. Similarly, after the 2008 financial crisis, those who stayed calm and bought value stocks saw massive long-term rewards. Practical tip: develop the emotional strength to do the opposite of the crowd. Buy when fear dominates and sell when greed blinds others. B. Investing in unpopular large companies. Graham observed that large established companies sometimes fall out of favor due to temporary setbacks or negative news. This creates buying opportunities for enterprising investors. He writes, the best values are often found in the large companies which are relatively unpopular. Example: in the early 2000s, when companies like Apple and IBM faced short-term troubles, many investors abandoned them. But those who understood their long-term potential and stable fundamentals saw enormous gains later. Practical tip: look for strong companies temporarily facing challenges, not those in permanent decline. Check if their financials remain solid, their brand strong, and their leadership capable. C. Bargain issues and special situations. This is one of Graham's favorite areas for enterprising investors. Special situations, what modern investors call workouts or distressed opportunities. These include companies trading below their liquidation value, stocks selling at deep discounts due to temporary problems, firms undergoing mergers, reorganizations, or spin-offs. Graham famously made much of his fortune by investing in such cases, where he could calculate the value with high certainty and little downside. Story: Graham Newman Corporation. Graham's own investment firm made remarkable returns buying companies selling below liquidation value. For example, he once bought shares of Northern Pipeline Company at less than the value of the cash it held. When the company distributed that cash, his fund made huge profits with minimal risk. Practical tip: look for opportunities others ignore. Read financial reports. If a company's market cap is lower than its cash or assets, it may be a bargain waiting to be discovered. D. Buying secondary companies with strong fundamentals. Not all successful investments come from big names. Graham encourages looking at secondary companies, smaller or less famous firms that may be undervalued because they're overlooked by large investors. He notes that smaller firms often have more room to grow and can be priced well below their true worth. However, this strategy requires deeper research. The enterprising investor must separate genuinely undervalued small firms from weak or speculative ones. Example: imagine finding a small manufacturing company with low debt,
steady profits, and a long track record, yet trading at half its book value simply because it's not trendy. That's a Graham-style opportunity. Practical tip: don't chase penny stocks or risky startups. Instead, find smaller companies with solid financials, consistent performance, and undervalued assets.
4. The importance of diversification. Even the best analysis can be wrong. That's why Graham insists that the enterprising investor diversify across 10 to 30 well-researched holdings. He explains that diversification is not just about increasing returns, but about reducing the impact of mistakes. Even the greatest investors make errors. Diversification protects you from any single failure. Practical tip: never put more than 10% of your portfolio into one company, no matter how confident you feel. Spread risk intelligently, but avoid over-diversification that dilutes returns. 5. Controlling emotions and expectations. In one of the most profound lessons of this chapter, Graham stresses that psychology matters more than strategy. He observes that most investors lose money not because they lack intelligence, but because they can't control emotion. Fear, greed, and impatience destroy returns. He writes, the investor's chief problem, and even his worst enemy, is likely to be himself. Example: during the 2008 crash, many investors sold in panic, locking in losses. Those who stayed disciplined and continued investing at lower prices saw strong recoveries. Practical tip: commit to a written investment policy. When emotions rise, rely on your plan, not on your impulses. Remember, volatility is not risk. Reaction to volatility is. 6. How the enterprising investor can beat the market. Graham never promises miracles, but he insists that consistent, disciplined effort can yield above-average returns. He points out that markets are not perfectly efficient. Human emotion creates mispricings, and the enterprising investor who researches deeply can profit from these opportunities. However, he also warns, to achieve better-than-average results, you must be willing to look different from the average investor. That means being patient when others are impatient, and rational when others are irrational. Practical tip: if your portfolio looks like everyone else's, you'll likely earn what everyone else earns: average returns. Dare to think independently, but always within the bounds of sound analysis. 7. The balance between caution and courage. One of the deeper messages of the chapter is the balance between caution and courage. The enterprising investor must have the courage to act when opportunities arise, but the caution to avoid speculation. This duality defines the intelligent investor. You must be both analytical and patient, skeptical yet open-minded, bold yet disciplined. Story: Warren Buffett's example. Warren Buffett, Graham's most famous student, embodies this principle. When everyone feared the market in 1974, Buffett was buying undervalued stocks aggressively. He later said, "Be fearful when others are greedy, and greedy when others are fearful." That mindset reflects Graham's balance perfectly. 8. Key takeaways and practical steps. Here's how you can apply Graham's positive approach to your own investing. Do your homework. Analyze companies. Don't rely on predictions or tips. Seek undervalued opportunities. Look for stocks trading below intrinsic value. Use a margin of safety. Always leave room for error in your calculations. Be patient and disciplined. Wait for the right price before buying. Diversify intelligently. Spread risk without losing focus. Control your emotions. Fear and greed are your greatest enemies. Act independently. Don't follow the crowd. Follow your analysis. Final thoughts. Chapter 7 of The Intelligent Investor is a masterclass in proactive, disciplined investing. Benjamin Graham shows that success doesn't come from speculation or luck. It comes from knowledge, patience, and integrity. He empowers you to become your own analyst, to recognize opportunity where others see fear, and to act with reason when others act with emotion. The enterprising investor, according to Graham, is not reckless. He is relentless in the pursuit of truth and value. In essence, Graham teaches that the real secret to superior investing is not finding magic formulas. It's thinking intelligently,
acting patiently, and always insisting on value over excitement.
Chapter 8. Investing in Investment Funds, Mutual Funds, and Beyond. In this chapter, Graham takes a step back from analyzing individual stocks and shifts his focus to investment funds, particularly mutual funds, which allow ordinary investors to participate in the market without picking individual stocks. Graham explores whether these funds live up to their promises, how to evaluate them intelligently, and how an investor can use them to build a balanced, profitable portfolio without losing sight of the principles of value investing. Let's dive in. 1. The rise of investment funds. Convenience meets complexity. By the mid-20th century, mutual funds had exploded in popularity. They were marketed as simple, safe, and professional ways for individuals to invest. Quote, "Leave the hard work to the experts," unquote, they promised. To many, it sounded like a perfect solution. Professionals manage your money, you enjoy the returns. But Graham, being the cautious realist, asks the critical question: do investment funds actually outperform the market or even justify their fees? He reminds readers that professional management does not guarantee superior results. Many fund managers, despite their expertise, fail to beat simple index averages over time. He writes, quote, "There is no reason at all for average funds to expect better than average results," unquote. In other words, if you're paying high fees for professional management but getting average performance, you're losing, because those fees eat into your long-term gains. Practical tip: don't assume that expertise equals outperformance. Always compare a fund's returns to the market index after accounting for fees. 2. The two types of investors: defensive versus enterprising. Graham once again divides investors into two categories: the defensive investor, who values safety and simplicity; the enterprising investor, who is willing to put in more effort for potentially higher returns. For the defensive investor, mutual funds can be useful, but only if chosen with care. For the enterprising investor, however, blindly relying on funds may be a lazy shortcut that defeats the very essence of intelligent investing. He notes that many investors fall into a psychological trap, thinking that by buying into a managed fund, they can outsource responsibility for performance. But the intelligent investor never stops thinking critically, even when professionals are involved. Lesson: delegating your investments doesn't mean delegating your judgment. Always know where your money is going and why. 3. Evaluating a fund the intelligent way. Graham outlines several key principles to evaluate mutual funds effectively. A. Past performance isn't predictive. Just because a fund performed well in the past doesn't mean it will continue to do so. In fact, Graham shows that many top-performing funds revert to average or below-average performance over time. He warns, quote, "The mutual fund industry's greatest sales tools are its past records, yet these are the least reliable guides to future success," unquote. Practical tip: be skeptical of glossy advertisements boasting about last year's double-digit returns. Instead, study the fund's long-term performance across 5, 10, or 15 years and compare it to market averages. B. Focus on costs and fees. Every dollar you pay in management fees or sales charges is a dollar less compounding for you. Many funds charge 1 to 2% annually, and some also add front-end or back-end load fees. Over decades, these small percentages can eat up tens of thousands of dollars in lost returns. Graham advises, quote, "Minimize all expenses. Small differences in cost will grow into enormous differences in results over the years," unquote. Example: if you invest $100,000 for 30 years at 8% annual return, you'll end up with about $1 million. But if you pay a 2% management fee, your effective return drops to 6%, leaving you with just $574,000. That's nearly half gone just from fees. Practical tip: prefer low-cost, no-load funds. Index funds, which simply track the market, often outperform actively managed funds after fees. C. Manager integrity and philosophy. The fund's success depends not only on skill, but also on management integrity.
Avoid funds that engage in excessive trading or speculative bets. Graham valued fund managers who showed consistency, caution, and discipline. Those who invest based on analysis, not market fads. Practical tip: read the fund's prospectus and annual reports. Look for managers who explain their decisions rationally, not emotionally. D. The fund's size and flexibility. As funds grow too large, they often lose agility. Managing billions makes it difficult to buy and sell smaller opportunities effectively. Graham notes that very large funds can become victims of their own success, forced to invest in large popular stocks just to deploy capital, which often reduces returns. Practical tip: sometimes smaller, well-managed funds offer better opportunities for growth, as long as they maintain discipline and transparency.
4. The hidden dangers of overconfidence. Graham warns of another trap: overconfidence in fund selection. Investors often believe they can pick the right mutual fund, just like people believe they can pick the next winning stock. But since most funds underperform over time, this is often a losing game. He humorously notes that picking mutual funds based on short-term performance is as risky as betting on racehorses based on their last race. Practical tip: instead of chasing hot funds, find stable ones with consistent performance, low costs, and a sensible long-term philosophy. 5. Investment funds versus index funds. Here, Graham's foresight shines brilliantly. Although index funds were still a new idea in his time, he championed them as the ideal vehicle for the defensive investor. He predicted that low-cost index funds, which simply mirror the market, would outperform the majority of actively managed funds after expenses. And history has proven him right. Decades later, data shows that most active managers failed to beat the index. He wrote, "By choosing a representative list and staying with it, the investor will obtain results that are likely to prove superior to the average." Practical tip: for most investors, a simple combination of low-cost index funds covering stocks and bonds can outperform complex portfolios with less stress and lower fees. 6. Investment trusts and closed-end funds. Before mutual funds became dominant, investment trusts, what we now call closed-end funds, were popular. These funds issue a fixed number of shares that trade on the stock exchange. Graham points out that closed-end funds often sell at discounts or premiums to their net asset value. For enterprising investors, buying these funds at a deep discount can be an intelligent move, as long as the underlying assets are sound. Example: if a closed-end fund holds assets worth $100 per share but trades at $85, an investor could gain both from appreciation in assets and from the discount closing over time. Practical tip: for enterprising investors, occasional opportunities may exist in discounted funds, but always verify that the portfolio is solid and well managed. 7. The psychology of fund investing. Perhaps the most striking insight in this chapter is psychological. Graham observes that most investors, and even fund managers, are emotional and trend-driven. They rush into funds when the market is high and bail out when it's low, exactly the opposite of intelligent behavior. He writes, "The intelligent investor must never permit himself to be swayed by the moods of the market." This is just as true today as it was in Graham's time. Many investors pour money into mutual funds during booms, only to panic and withdraw during declines. Practical tip: set a long-term plan for your fund investments. Contribute regularly through dollar-cost averaging and ignore short-term volatility. 8. Practical guidance for today's investor. Here's how you can apply Graham's fund principles in modern investing. Choose low-cost index funds as your foundation. Don't chase performance. Last year's winners often become this year's losers. Diversify across asset classes, stocks, bonds, and perhaps real estate. Check fees and turnover ratios. The lower, the better. Be patient. Long-term consistency beats short-term brilliance. Example portfolio: defensive investor, 60% in a total stock market index fund, 30% in a total bond market index fund, 10% in cash or short-term bonds for flexibility. Example portfolio for enterprising investor: 50% in index funds, 30% in carefully selected undervalued stocks, and 20% in special situations or discounted funds. Final thoughts. Chapter 8 is Benjamin Graham's powerful reminder that even in collective investing, individual intelligence matters most. He doesn't dismiss mutual funds. He refines how we should use them, as tools, not as crutches. He encourages investors to think long-term, minimize costs, and stay emotionally grounded, values that have made his philosophy timeless. So whether you're a defensive investor seeking peace of mind or an enterprising one looking for edges, Graham's message is clear. Success isn't about picking the perfect fund. It's about staying rational, patient, and disciplined.
Chapter 9. Investing in Investment Funds, Mutual Funds and Beyond. In this chapter of The Intelligent Investor by Benjamin Graham, we explore one of the most impactful innovations in modern finance, investment funds, or more specifically, mutual funds. Graham carefully analyzes how these funds work, their benefits, their limitations, and how intelligent investors can use them wisely to achieve long-term financial success. 1. Understanding investment funds, a collective approach to investing. Graham begins this chapter by explaining the purpose of investment funds. These are organizations that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. The idea is simple. Instead of managing your investments alone, you hire professionals to do it for you, while also gaining the benefits of diversification and reduced risk. This concept appeals especially to small investors who might lack the time, experience, or capital to analyze individual securities effectively. By investing in a mutual fund, they can own a small portion of hundreds or even thousands of companies, something that would be impossible to replicate individually. However, Graham reminds us that even though mutual funds make investing easier, they do not eliminate risk or guarantee superior returns. They still operate within the same unpredictable market environment. The professional managers are not magicians. They are simply better equipped players in the same game. 2. The appeal of mutual funds, convenience and diversification. Graham recognizes several advantages of investing in funds. Professional management. Funds employ experienced managers who analyze markets and securities daily. This relieves investors from the burden of constant monitoring and research. Diversification. By pooling many securities, funds reduce the impact of one or two poor performers on the overall portfolio. Accessibility. Even with a small investment, you can participate in the broader stock market. Liquidity. Mutual funds allow investors to buy or redeem shares easily, typically at the fund's net asset value, or NAV. These qualities make mutual funds particularly attractive to everyday investors who want a hands-off approach to building wealth. But as Graham cautions, convenience often carries a hidden cost. 3. The hidden costs. Fees, commissions, and overperformance myths. Here's where Graham's timeless skepticism shines. He highlights that most mutual funds do not outperform the market in the long run, especially after accounting for fees and expenses. Graham identifies several types of charges that erode investor returns. Management fees, a percentage charged annually, often 1 to 2% of your total investment. Sales loads, upfront or back-end commissions paid when buying or selling fund shares. Operating expenses, administrative costs, advertising, and other expenses deducted from fund assets. While these costs may appear small, they compound over time and can significantly reduce the investor's ultimate gains. For instance, a 2% annual fee might not sound alarming, but over 30 years it can consume nearly half of your total returns. Graham's advice is clear. The investor's chief problem, and even his worst enemy, is likely to be himself. Investors often get lured into high-cost funds because of marketing, performance hype, or emotional decisions. Instead, Graham urges us to focus on low-cost, passively managed funds. 4. The performance fallacy. Why most funds fail to beat the market. A central question Graham tackles is, do professional managers actually outperform the market? His analysis, which still holds true today, is a resounding no. He presents compelling evidence that only a small fraction of mutual funds consistently beat market averages over extended periods. Even when they do,
It's often due to luck rather than skill. Graham humorously notes that in a large enough group, some managers will always appear successful, just like some coin flippers will get 10 heads in a row purely by chance. He reminds us that the intelligent investor must not confuse luck with genius. Performance charts and past returns can be deceptive, and chasing hot funds usually leads to disappointment. This principle is echoed in modern investing through the rise of index funds, a concept that perfectly embodies Graham's philosophy. 5. The rise of index investing. Graham's enduring wisdom. Although index funds were not yet popular when Graham wrote The Intelligent Investor, his ideas paved the way for their creation. He advocated for unmanaged investment funds that simply track a broad market index without trying to beat it. This strategy eliminates costly management fees and emotional decision-making. It ensures that you'll achieve market average returns, which over the long run outperform the majority of actively managed funds. Graham's philosophy was later championed by John Bogle, the founder of Vanguard, who often called The Intelligent Investor one of his greatest influences. The result was a revolution in investing, one that made wealth building accessible and efficient for millions of everyday investors.
6. The psychology of fund investing, avoiding common mistakes. Graham explores how emotions drive poor fund decisions. Many investors buy into funds after they've had a good run, when prices are already high. Panic and sell during downturns, locking in losses. Chase trends instead of sticking to a long-term plan. He calls this the performance obsession, where investors mistake recent success for lasting skill. Graham advises the intelligent investor to remain calm, rational, and disciplined, focusing on consistent, long-term growth rather than quick profits. He emphasizes that even in funds, discipline is more important than brilliance. 7. Practical guidance, choosing the right fund. To put his lessons into action, Graham offers several practical tips. Prefer no-load funds. Avoid funds that charge sales commissions. Your money should go into investments, not marketing. Minimize expenses. Favor funds with low annual fees. Over time, these small savings add up. Look for broad diversification. Choose funds that track large, diversified indexes, such as the S&P 500 or total market funds. Avoid performance chasing. Don't pick funds based on short-term returns. Past performance rarely predicts future success. Be patient. Treat your fund investment like owning a share of the entire economy. Let it grow through market cycles. Following these principles, Graham asserts, will allow even the most ordinary investor to achieve extraordinary results over time. 8. Key takeaways. What the intelligent investor should remember. To summarize the key lessons from Chapter 9, mutual funds provide convenience and diversification, but come with hidden costs. Many active managers fail to outperform the market consistently. Low-cost index funds are the modern expression of Graham's wisdom. Investor behavior, not fund selection, often determines success or failure. Long-term discipline and cost consciousness remain the most reliable paths to wealth. Graham closes with a reminder that applies perfectly to today's investing world. The more the market's behavior departs from logic, the more opportunity there is for disciplined investors to profit from it. In essence, even when using mutual funds, intelligence lies not in beating others, but in mastering yourself. 9. Practical application, bringing Graham's wisdom into your life. Here's how you can apply this chapter's insights in your daily investing life. Start simple. Choose a single low-cost index fund or ETF that tracks a major index like the S&P 500. Automate your contributions. Invest monthly through automatic transfers, regardless of market conditions. Reinvest dividends. Let compounding work silently in your favor. Ignore market noise. Don't let headlines or temporary declines shake your confidence. Review annually, not daily. Focus on your long-term goals, not short-term fluctuations. By doing this, you'll embody Graham's vision of the true intelligent investor, one who combines simplicity, patience, and principle to build lasting wealth. In summarizing Chapter 9, Graham reveals the science behind mutual funds, their hidden costs, and the wisdom in investing in low-cost index funds or ETFs for long-term financial prosperity.
Chapter 10.
The Investor and His Advisors, Navigating Financial Guidance Wisely. In this chapter of The Intelligent Investor by Benjamin Graham, we dive into one of the most important and often misunderstood aspects of investing: how to deal with financial advisors, experts, and professionals. Graham, as always, approaches the topic with realism and caution. He does not reject the value of professional advice, but he reminds us that true intelligence in investing lies in understanding when to trust, when to question, and when to think for yourself. Why investors seek advisors. Graham begins by explaining why people naturally look for financial guidance. Investing can be intimidating. Markets fluctuate, economic reports are complex, and the fear of making a costly mistake is real. So many investors turn to financial advisors, brokers, or so-called experts to tell them what to buy, when to sell, and how to grow their wealth. But Graham reminds us that while seeking help is human, blindly following advice is dangerous. The financial world is filled with individuals whose interests may not fully align with yours. Many advisors, especially brokers, are compensated through commissions, meaning their goal is often to sell, not necessarily to serve. This difference between advice that helps you and advice that benefits them is central to Graham's message. The nature of financial advice. Two kinds of advisors. The sincere but fallible expert. This type genuinely wants to help, but is often overconfident or misled by the same emotions that affect all investors: fear, greed, and the illusion of certainty. They might rely heavily on predictions, trends, or market timing, which Graham repeatedly warns against. The salesman in disguise. These are professionals whose advice is influenced more by commissions or sales targets than genuine concern for the investor. They promote new products, funds, or stocks, not because they're good, but because they're profitable for them. Graham's key insight is simple but profound. The investor's greatest safeguard lies in his ability to think independently. Even the most trustworthy advisor cannot replace your own judgment. You must always retain final responsibility for your investment decisions. The role of the intelligent investor: trust but verify. Graham does not dismiss the need for advisors entirely. In fact, he acknowledges that many investors lack the time, patience, or temperament to analyze the market themselves. In such cases, seeking guidance is sensible, as long as you understand how to manage the relationship wisely. He suggests the intelligent investor should demand transparency. Know how your advisor is compensated. Fee-only advisors, who charge a flat rate rather than commissions, are generally more trustworthy. Ask for evidence. Require data, not opinions. Sound advice should be based on historical evidence, not speculation. Stay skeptical of predictions. Avoid anyone claiming they can beat the market or predict the next big stock. These are emotional traps. Maintain control. Let your advisor guide you, not command you. This approach transforms your relationship from dependency to partnership. You use your advisor as a source of perspective, not as a substitute for your own reasoning. The problem of market forecasts and expert predictions. One of the most entertaining yet sobering parts of this chapter is Graham's attack on market forecasts. He calls them an exercise in futility, noting that even the most seasoned professionals fail to predict market movements accurately. He compares financial forecasting to weather prediction, except markets are even more unpredictable because they are driven by human emotion. Greed, panic, and herd behavior make markets behave irrationally, rendering precise forecasts nearly impossible. He provides examples of how professional analysts and investment houses often contradict each other. In the same month, one expert might predict a bull market, while another foresees a crash, and both will sound equally convincing. His advice? The intelligent investor must refuse to be impressed by what many experts claim to know. Instead, focus on timeless principles, diversification, margin of safety, and patience, rather than short-term forecasts or hot tips. The ethical and psychological challenges of advisors. Graham also explores the psychological dynamics between investors and their advisors. Often, clients expect their advisors to have special insight or even inside knowledge. Advisors, feeling pressured to meet those expectations, may end up pretending to know more than they actually do. This creates a cycle of mutual delusion. The client wants certainty, and the advisor feels obligated to provide it. The result is overconfidence, risky decisions, and disappointment. Instead, Graham recommends that both parties embrace humility. A good advisor should be honest about the limits of their foresight, and a good client should value prudence over excitement. In Graham's words, "The investor who permits himself to be deceived by glamorous promises deserves his fate."
6. The right kind of advisor, a true financial partner. So, what does a truly valuable advisor look like? Graham describes the ideal financial counselor as conservative in approach, focused on protecting capital before seeking profit. Evidence-based, relies on historical data and proven strategies, not speculation. Educative, helps clients understand the reasoning behind decisions. Discipline-oriented, keeps clients calm during volatility and prevents emotional reactions. Ethically grounded, places the client's interest above all else. Such an advisor acts not as a profit or salesperson, but as a coach, guiding you toward consistent, rational behavior. In modern terms, this describes a fiduciary financial advisor, someone legally bound to act in your best interest. Graham, ahead of his time, was essentially calling for fiduciary standards decades before they became mainstream. 7. The investor's responsibility. Knowledge is power. Even with a trustworthy advisor, Graham insists that the ultimate responsibility rests on you, the investor. You cannot outsource understanding. You don't need to become a financial genius, but you must have enough knowledge to evaluate advice intelligently. He suggests every investor learn the basics of how stocks and bonds work, the difference between investing and speculating, the meaning of diversification and risk tolerance, and how to read a balance sheet and income statement, at least at a surface level. By knowing the fundamentals, you protect yourself from manipulation and confusion. You become what Graham calls an educated layman, capable of separating sound advice from clever salesmanship. 8. Practical applications. How to work with advisors wisely. Here are some of Graham's timeless practical tips for investors dealing with financial professionals. Set clear goals. Know your investment purpose, income, growth, or preservation before hiring anyone. Avoid frequent changes. Don't allow advisors to push constant portfolio revisions. Long-term strategies win. Beware of emotion-driven suggestions. Be cautious if your advisor becomes overly optimistic or pessimistic about the market. Review, don't react. Meet periodically to review performance objectively rather than reacting to every market move. Keep costs in check. Make sure advisory fees and trading commissions remain reasonable. These principles keep you grounded and ensure that you remain the CEO of your financial life, with your advisor serving as a consultant, not a controller. 9. Key lessons from Chapter 10. Let's recap the central insights. Advisors can be useful, but not infallible. You must always think independently. Avoid prophets and market forecasters. They're more often lucky than skilled. Character matters more than confidence. Choose advisors with integrity and humility. Knowledge is your shield. Understand basic investing principles to protect yourself. Emotions are your enemy. A good advisor helps you stay disciplined through market cycles. Graham concludes this chapter with timeless wisdom. Good advice is valuable only to those who are capable of following it intelligently. That means your success depends not only on finding the right mentor, but also on becoming the kind of investor who listens with reason, not emotion. 10. Practical integration. Applying Graham's wisdom today. Here's how you can apply this lesson in real life. Do your homework before hiring any advisor. Check credentials, fees, and client reviews. Prefer fiduciary advisors who act in your best interest, not those paid by commission. Learn continuously. Listen to finance podcasts, read trusted books, and keep improving your understanding. Build emotional discipline. Even the best advice won't help if you panic when the market dips. Balance autonomy with guidance. Use experts for insight, not for control over your money. When you adopt this mindset, you become a true intelligent investor, informed, calm, and in charge of your financial destiny.
Chapter 11. Security Analysis for the Lay Investor. General Approach. In this chapter of The Intelligent Investor, Benjamin Graham demystifies a term that intimidates many investors: security analysis. Security analysis simply means evaluating whether a stock, bond, or any investment is worth its price. Graham's goal here is not to make you a professional analyst, but to teach you how to think like one, calmly, logically, and independently. Let's explore how Graham empowers the lay investor, the ordinary person, to analyze securities without fear or confusion. 1. The meaning of security analysis. Graham begins by clarifying what security analysis truly means. Many people assume it involves complex formulas, financial models, or insider knowledge. In reality, it's just the art of determining whether an investment offers value greater than its price. He explains that every stock represents ownership in a real business. Therefore, the task of the intelligent investor is not to treat stocks as gambling chips, but to evaluate them as businesses. He writes, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return." This single definition separates the intelligent investor from the speculator. Security analysis is simply the systematic process of confirming that the business you're buying into is sound and that you're paying a reasonable price for it. 2. The goal: avoiding stupidity, not seeking genius. One of Graham's most comforting lessons in this chapter is that you don't need to be brilliant to succeed. You just need to avoid making foolish mistakes. He emphasizes that the ordinary investor doesn't have to predict which company will become the next Apple or Amazon. Instead, focus on avoiding overpriced, overhyped, or unstable companies. Graham writes, "The function of the security analyst is not to be right all the time, but to be careful most of the time." In other words, your goal is not perfection, but protection. By applying reason and patience, you'll naturally outperform those chasing excitement or acting on emotion. 3. The 3 pillars of security analysis. Graham outlines 3 main elements that every investor should examine when evaluating a security. 1. The company's financial condition. Look at its balance sheet and income statement. Key factors include debt levels. Are they reasonable compared to earnings? Profit margins. Are they consistent or shrinking? Dividend history. Does the company have a record of rewarding shareholders? Liquidity. Does it have enough cash to survive downturns? You don't need to be an accountant. Just focus on stability, consistency, and the absence of red flags. 2. The company's earning power. Graham suggests analyzing a company's average earnings over at least 5 years. This smooths out short-term volatility and reveals whether the business can reliably generate profits. A company that earns steadily, even modestly, is often a safer investment than one with dramatic ups and downs. 3. The company's future prospects. Here Graham offers an important warning. The future is uncertain, and forecasts are unreliable. Instead of trying to predict explosive growth, look for durable advantages like brand loyalty, strong management, or a consistent demand for the company's products. He writes, "The future value of every investment is a function of its present price." The intelligent investor therefore doesn't chase trends. They buy proven businesses at reasonable prices. 4. The problem of overvaluation. Graham repeatedly warns against overpaying no matter how good a company looks. Even the best business becomes a bad investment if bought at too high a price. He uses a simple metaphor. Imagine buying a $1 bill for $1.50 just because you think it might someday be worth $2. That's speculation, not investing. Instead, you must always leave a margin of safety, a gap between the stock's intrinsic value, what it's truly worth, and its market price. This principle is the cornerstone of all intelligent investing. He writes, "The margin of safety is the difference between the price paid and the intrinsic value." This buffer protects you from errors in judgment, bad luck, and market volatility.
If you buy a solid company at a fair price, or better, at a discount, you dramatically reduce your risk. 5. Simplified approach for the ordinary investor. Graham understands that most of us don't have the time or expertise to conduct deep financial analysis, so he offers a practical shortcut for the everyday investor. Instead of analyzing every detail, focus on the following simple rules. Buy only financially strong companies. Look for firms with a solid balance sheet and consistent profitability. Avoid companies with excessive debt. High debt makes businesses vulnerable during recessions. Favor companies with a history of dividends. Regular dividend payments signal financial stability and discipline. Ignore the crowd. Popular stocks are often overpriced. Seek value where others overlook it. Diversify wisely. Hold 10 to 30 different stocks across industries to reduce risk. By applying these filters, you can construct a portfolio that is both safe and rewarding without the need for constant market monitoring.
6. The role of intrinsic value. A central theme in this chapter is intrinsic value, the real worth of a company based on its assets, earnings, and long-term potential. Graham compares it to a scale that keeps you balanced in a world full of speculation. He reminds investors that while market prices fluctuate wildly due to emotion, intrinsic value changes slowly based on fundamental business performance. Therefore, when market price is less than intrinsic value, buy. When market price is greater than intrinsic value, be cautious or sell. By focusing on intrinsic value, you avoid emotional decisions and base your investments on reality, not hype. 7. Mr. Market and emotional discipline. Although Mr. Market was introduced earlier, Graham revisits him here to emphasize emotional discipline in analysis. Mr. Market is your imaginary business partner who offers to buy or sell shares daily, but his moods swing between optimism and despair. Your job is not to mirror his emotions, but to take advantage of them. When he's depressed and offers low prices, buy. When he's euphoric and offers high prices, hold or sell. In security analysis, this metaphor teaches you to view price fluctuations not as threats, but as opportunities. 8. Common pitfalls for amateur analysts. Graham lists several traps that novice investors fall into. Overconfidence in predictions, believing they can outsmart the market. Following the crowd, buying because everyone else is. Chasing performance, investing in last year's winners. Ignoring fundamentals, choosing companies based on hype or emotion. He warns that these behaviors lead to one outcome, buying high and selling low, the opposite of success. To avoid this, Graham recommends staying anchored to facts, not forecasts. 9. Practical application. How to apply security analysis. Let's break down how you can apply Graham's ideas today. Study basic financial statements. You can find them free on investor websites or Yahoo Finance. Focus on debt, earnings, and cash flow trends. Use valuation ratios. Simple metrics like P/E ratio or P/B ratio can signal whether a company is undervalued. Compare within industries. A P/E ratio that's low compared to competitors may indicate a bargain. Be patient. True value takes time to be recognized. Don't expect instant results. Reevaluate annually. Review whether each company still meets your investment criteria. By practicing these steps consistently, you'll naturally develop an analytical mindset, the hallmark of an intelligent investor. 10. Graham's timeless reminder. Graham ends the chapter by reminding readers that security analysis is not about finding perfection. It's about minimizing risk and maximizing understanding. He writes, "To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks." In other words, you don't need to outsmart everyone. You just need to avoid being foolish. Invest in solid businesses at fair prices and let time and discipline do the rest. 11. Practical takeaways for the modern investor. Focus on value, not hype. Always ensure a margin of safety. Avoid emotional decisions. Favor steady, dividend-paying companies. Review your holdings regularly, but resist unnecessary changes. By mastering these steps, you become not just an investor, but a rational owner of businesses,
guided by facts, not feelings.
Chapter 12. The Investor as Business Owner. In Chapter 12 of The Intelligent Investor, Benjamin Graham reinforces one of the most profound yet often overlooked ideas in the entire world of investing. When you buy a stock, you're not buying a ticker symbol. You're buying ownership in a business. This chapter lays the foundation for intelligent investing by shifting the investor's mindset from speculation to ownership, from chasing market movements to evaluating business performance. 1. The central principle: owning a business, not a stock. Graham begins by reminding readers that the stock market is a secondary market for business ownership. Every share of stock represents a fraction of ownership in an actual company that produces goods, provides services, employs people, and earns profits. However, many investors forget this fundamental truth. They get lost in daily market fluctuations, rumors, and media noise, treating stocks like lottery tickets instead of long-term business interests. Graham insists that intelligent investors must think like business owners, not gamblers. When you view stocks this way, you naturally start asking better questions. How strong is the company's balance sheet? What are its earnings prospects? Who manages it, and how well do they allocate capital? What risks threaten its business model? This mindset shift alone separates the intelligent investor from the average speculator. 2. Stocks represent real businesses. To illustrate this point, Graham provides an example. Imagine buying a small local business, say a neighborhood grocery store. You would naturally investigate its earnings, expenses, debts, customer base, and competition before making an offer. You'd care about the long-term prospects, not the daily price someone offers to buy it from you. Yet when it comes to buying shares in large companies, investors often skip this due diligence entirely. They'll buy or sell based on the market's mood swings, which Graham famously calls Mr. Market's emotional outbursts. The intelligent investor, on the contrary, treats every stock purchase as if he were buying the entire business. This approach encourages rational decision-making, patience, and focus on intrinsic value, the real worth of the business based on its fundamentals. 3. Focus on earnings power, not price fluctuations. Graham advises investors to evaluate a company based on its earnings power, its ability to generate consistent profits over time. Stock prices may fluctuate wildly, but the company's true value depends on its long-term ability to earn money. He encourages looking at least 5 to 10 years of past earnings to understand how stable and resilient the business has been. Has it grown consistently? Has it weathered recessions? Has management maintained profitability during tough times? A stock's price may sometimes fall even as the company's profits rise, or rise when earnings decline. Graham warns that price and value are not the same, and the investor's goal is to take advantage of that difference. 4. The importance of management quality. Another key insight in this chapter is the importance of trustworthy and capable management. Graham recognizes that when you invest in a company, you're entrusting your money to its executives. Their decisions, how they allocate profits, manage debt, and pursue growth can significantly affect shareholder returns. He warns against management teams that engage in excessive stock issuance, diluting shareholders, take on unnecessary debt for risky expansions, manipulate accounting to inflate earnings, reward themselves disproportionately through bonuses and options. Instead, look for management that is conservative, honest, and shareholder-oriented, leaders who think long-term, prioritize stability, and communicate transparently. 5. Understanding dividends and retained earnings. Graham highlights 2 major ways businesses create value for their owners: paying dividends, returning cash profits directly to shareholders, and retaining earnings, reinvesting profits back into the business for growth. He explains that an intelligent investor should evaluate how well a company reinvests its earnings. Retaining profits only makes sense if the company can earn a high rate of return on that reinvested capital. Otherwise, it's better to distribute profits through dividends. For example, a company earning 20% returns on reinvested capital can compound shareholder wealth effectively, while another earning just 5% should probably pay that money out instead of reinvesting poorly. This is why analyzing return on equity and profit margins becomes essential. These metrics reveal how efficiently a company turns shareholder money into profits.
6. Long-term thinking versus short-term speculation. One of the most timeless lessons in Chapter 12 is Graham's call to think long-term. Short-term market movements are random and often irrational. Prices may rise or fall for reasons unrelated to business fundamentals, like economic news, political events, or investor sentiment. But over the long run, the market is a weighing machine, not a voting machine. It weighs the real substance of a company, its earnings, assets, and growth prospects. Graham's advice: ignore short-term market noise and stay focused on the business. This approach builds patience and prevents panic during downturns. Remember, if the underlying business remains strong, a temporary price decline is not a loss, it's a buying opportunity. 7. Example: Coca-Cola and the power of ownership thinking. Let's take a real-world example to bring this principle to life. Imagine you bought Coca-Cola stock in the 1980s. Over the decades, you wouldn't just be holding a piece of paper, you'd be owning part of one of the world's most recognized brands, with an expanding global customer base and steady profits. Even when market prices fluctuated wildly during recessions, wars, or crises, the business itself continued to sell billions of drinks every day. Investors who saw themselves as business owners and held their shares long-term reaped massive rewards through dividends and capital appreciation. This mindset, seeing yourself as part owner of a real enterprise, is the very essence of Graham's philosophy. 8. Practical lessons for modern investors. Here are actionable ways you can apply Chapter 12's wisdom. Research like a business owner. Before buying a stock, read annual reports, study balance sheets, and understand the company's competitive advantages. Focus on intrinsic value, not market price. Estimate what the company is truly worth based on earnings, assets, and growth, not just what others are willing to pay today. Think long-term. Hold investments through market cycles. Let your ownership compound over time. Monitor management behavior. Look for transparent, shareholder-focused leaders. Avoid companies with excessive debt or executive greed. Reinvest dividends wisely. Use dividends to either buy more shares in undervalued companies or diversify your portfolio. Stay rational. When prices drop, remind yourself you still own the same business. If its fundamentals remain intact, the market's mood doesn't change your true wealth. 9. The core takeaway. Benjamin Graham's ultimate goal in this chapter is to reshape how investors see the stock market. The intelligent investor views each stock not as a speculative instrument, but as a living, breathing business with real people, products, and profits behind it. This perspective transforms investing from a gamble into a rational, rewarding pursuit. When you buy a stock, you're buying into a story, a company's journey, its successes, its challenges, and its long-term potential. As Graham puts it, investment is most intelligent when it is most businesslike. By adopting this mindset, you join the ranks of investors who see beyond price movements, those who build wealth steadily by owning great businesses and holding them through time.
Chapter 13, a comparison of 4 listed companies. In Chapter 13 of The Intelligent Investor, Benjamin Graham brings his theories to life by applying them to real-world examples. This chapter is a practical demonstration of how an intelligent investor should analyze and compare businesses, not based on speculation or stock tips, but by using objective financial data and long-term reasoning. Graham carefully examines 4 real companies, as of the 1970s, to highlight what makes one stock safer or riskier, overvalued or undervalued, and intelligent or foolish as an investment. While the companies he discussed were specific to his era, the principles remain timeless. This chapter is about learning how to think like an investor, not a trader, using data, discipline, and perspective rather than emotions or fashion. 1. The purpose of this chapter. Graham begins by explaining that the goal is not to predict which stock will perform best, but to illustrate the methods of comparing investments intelligently. He wants the reader to understand what information to look for in a company's financials, how to assess whether a stock is priced reasonably, how to recognize excessive risk, and most importantly, how to separate speculation from investment. By examining 4 listed companies side by side, Graham demonstrates that numbers tell stories of strength, weakness, prudence, and greed. 2. The 4 companies. Although the specific companies have changed over time, Graham's examples include a mix of large and small firms, stable and speculative ones, and different industries. The idea was to contrast conservative investments with risky ones that only appear attractive at first glance. To make this easier to understand, let's restate Graham's framework using modern parallels. Imagine comparing companies like Procter & Gamble, stable consumer goods, Tesla, high growth, volatile, General Motors, cyclical industry, and a small speculative tech startup. The comparison teaches us what to look for when assessing real businesses. Lesson 1. Earnings stability versus volatility. The first thing Graham looks at is earnings consistency, how stable a company's profits have been over time. He finds that conservative companies, like utilities or consumer goods firms, show steady and predictable earnings even through recessions. Riskier companies may show rapid earnings growth during boom years, but also steep declines or losses when the economy slows. Lesson: an intelligent investor prefers companies with long-term earning stability rather than those with erratic profits. The investor's chief problem, and even his worst enemy, is likely to be himself, Graham reminds us. Chasing hot stocks with flashy earnings is one of the most common emotional traps. Lesson 2. Valuation matters more than growth. Graham compares price-to-earnings ratios, showing that the market often overpays for popular growth companies while ignoring steady, unglamorous ones. For example, a company with a P/E ratio of 40 might look exciting due to its rapid sales increase, but another with a P/E of 10 might offer far more value if its earnings are stable and dividends reliable. Over time, he observes, the undervalued but solid companies outperform the overvalued darlings. Lesson: growth is only valuable if it comes at a reasonable price. A great company can still be a terrible investment if you overpay for it. This is the foundation of what Warren Buffett later called buying a wonderful company at a fair price, a principle directly inherited from Graham. Lesson 3. Financial strength is key. Next, Graham analyzes the balance sheets, the financial foundation of each company. He checks the ratio of current assets to current liabilities, liquidity, the amount of long-term debt relative to earnings, whether the company holds ample cash reserves. He notes that companies with too much debt may look profitable during good times but are vulnerable when interest rates rise or sales drop. In contrast, companies with strong financial positions can endure downturns, protect dividends, and invest when competitors are struggling. Lesson: avoid over-leveraged businesses. Favor those with conservative financing and strong balance sheets. Practical example: during the 2008 financial crisis, companies with excessive debt, like Lehman Brothers, collapsed overnight, while financially conservative firms like Johnson & Johnson or Berkshire Hathaway stayed resilient and even expanded.
6. Lesson 4. Dividends as a sign of quality. Graham puts strong emphasis on dividends, not just as income, but as evidence of a company's financial discipline and shareholder respect. He compares firms that consistently pay dividends to those that withhold profits for growth projects but never seem to deliver real returns. Consistent dividends prove that a business generates real profits and values its shareholders. Lesson: dividends are not just about income. They signal financial health, management integrity, and sustainable earnings. A company that cuts its dividend repeatedly or avoids paying one altogether should be treated with caution, unless it can show a clear and profitable reinvestment strategy. 7. Lesson 5. The danger of overconfidence and fashion. Graham cautions against the illusion of safety in popularity. Investors often assume that because a stock is widely admired, it must be a good buy. He warns that market favorites, the blue-chip darlings, often become overvalued. Conversely, neglected or unfashionable companies may be trading below their true worth. The more enthusiastic the public grows about a company, the more certain it is to disappoint, he writes. This insight applies perfectly to modern markets. Think of how tech stocks or cryptocurrencies attract waves of optimism, driving prices far beyond any rational value. Eventually, reality returns,
and those who chased hype without understanding fundamentals pay the price. 8. Lesson 6. Comparing long-term performance. Graham concludes his comparison by showing that, over a decade or more, the conservative, undervalued companies outperform the exciting growth ones. Why? Because while the speculative stocks deliver quick bursts of gains, they also suffer devastating declines. The stable, dividend-paying companies may grow slowly, but they do so steadily, compounding quietly in the background. This long-term advantage demonstrates what Graham calls the margin of safety, buying with a buffer between price and value. The margin of safety is achieved when securities are purchased at prices sufficiently below their intrinsic value to allow for human error, bad luck, or economic misfortune. 9. A modern interpretation. If we apply Graham's approach today, it might look like this. Company A, a fast-growing tech firm with sky-high valuation and heavy debt. Company B, a mature industrial firm with steady earnings, low debt, and strong dividends. While Company A excites speculators, Company B comforts investors. 10 years later, Company A may be gone, acquired, or devalued, while Company B continues to quietly deliver compound returns. This is not just theory. History proves it. Coca-Cola, Procter & Gamble, and Johnson & Johnson have outlasted hundreds of hot tech or dot-com companies that once dominated headlines. 10. How to apply Chapter 13 in real life. Here are some practical steps to apply Graham's comparative analysis approach. Compare before you commit. Don't evaluate one company in isolation. Look at least 3 or 4 in the same sector to understand what's normal and what's exceptional. Study financial statements. Focus on earnings stability, debt ratios, and dividend history. Avoid companies with erratic profits or aggressive financing. Don't chase popular stocks. If everyone is buying it, chances are it's already overpriced. Think in decades, not days. Ask, will this company still be strong 10 years from now? Insist on a margin of safety. Only buy when the price offers a cushion against unforeseen events. Favor simplicity over complexity. If you can't understand how a company makes money, don't invest in it. The core message. Graham's comparison of 4 companies was not about choosing winners. It was about learning how to think like an analyst. The intelligent investor does not rely on luck, emotion, or predictions. Instead, he relies on evidence, discipline, and patience. This chapter is a reminder that the most successful investors are not those who chase the latest trends, but those who calmly and rationally compare opportunities and act only when the odds are in their favor. It is astonishing how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent. End quote. Charlie Munger, echoing Graham's philosophy.
Chapter 14. Stock Selection for the Defensive Investor. Chapter 14 is one of the most practical and powerful sections of The Intelligent Investor. Here, Benjamin Graham lays down a clear and disciplined roadmap for the defensive investor, someone who wants to build long-term wealth safely without spending endless hours analyzing the market. This chapter answers a fundamental question. How can ordinary people invest intelligently, safely, and successfully, even if they're not financial experts? 1. Who is the defensive investor? Graham divides investors into 2 broad types: defensive or passive, investors cautious, conservative, and primarily concerned with safety and steady returns; enterprising or active, investors willing to put in significant time and effort to analyze and select undervalued securities. The defensive investor's goal is not to beat the market, but to avoid big mistakes and earn satisfactory returns over time. The defensive investor's chief aim is to avoid serious loss. His second aim is freedom from effort, annoyance, and the need for making frequent decisions. This type of investor values peace of mind over excitement. 2. The 2 broad investment choices. According to Graham, the defensive investor has 2 primary avenues for building wealth. 1. High-grade bonds or similar fixed-income securities. 2. high-grade common stocks. He insists on maintaining a balance between the two. His famous recommendation: the investor should never have less than 25% or more than 75% of his funds in common stocks and the remainder in bonds. This flexible ratio allows the investor to adjust based on market conditions. For example, leaning toward stocks when prices are low and toward bonds when prices are high. The goal isn't perfection, but balance. 3. Characteristics of suitable common stocks. Graham outlines 6 criteria for selecting individual stocks safely. Each is a safeguard against speculation and overconfidence. Criterion 1. Adequate company size. Avoid very small companies. Larger firms are more likely to survive economic storms. In modern terms, focus on companies with multi-billion-dollar market capitalizations and global operations. Criterion 2. Strong financial condition. For industrial companies, current assets should be at least twice current liabilities, a current ratio of 2 to 1. In essence, no excessive leverage. Criterion 3. Earnings stability. The company must have had positive earnings for at least the past 10 years, a proof that it can survive multiple economic cycles. Criterion 4. Dividend record. It must have paid uninterrupted dividends for at least 20 years. This shows management's commitment to shareholder value and the firm's consistent profitability. Criterion 5. Earnings growth. There should be at least a 1/3 increase in per-share earnings over the past 10 years, a sign of steady, healthy growth. Criterion 6. Moderate price-to-earnings ratio. The P/E ratio should not exceed 15 times average earnings over the past 3 years. This ensures that the investor is not overpaying for future expectations. Price is what you pay. Value is what you get. Warren Buffett, summarizing Graham's wisdom. 4. Avoiding the glamour trap. Graham strongly warns against buying hot or glamour stocks, those heavily advertised or hyped because of recent performance. He notes that past growth is no guarantee of future success, and investors who buy these fashionable companies often pay inflated prices. When the glamour fades, prices collapse. Instead, he recommends boring but stable companies, those that produce essentials, have dependable earnings, and operate quietly without headlines. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. 5. Diversification, the defensive investor's secret weapon. No matter how stable or reliable a company looks, Graham insists that diversification is the cornerstone of safety. He recommends holding a portfolio of 10 to 30 high-quality stocks distributed across industries. This reduces the impact of any single failure and ensures consistent average performance. In essence, don't put all your eggs in one basket, and don't put them all in one type of egg. Modern investors can achieve this through index funds or ETFs, which automatically diversify risk and mirror the market's long-term growth.
6. The role of index funds. Interestingly, Graham predicted the rise of index funds long before they became popular. He wrote that the simplest, most effective way for a defensive investor to invest is to own a diversified group of stocks without trying to pick winners. He states that owning shares of a broad market index gives you all the benefits of capitalism without the risks of speculation. The investor who permits himself to be stampeded or unduly worried by unjustified market declines is perversely transforming his basic advantage into a basic disadvantage. John Bogle, founder of Vanguard and creator of the first index fund, later credited Graham as the intellectual father of passive investing. 7. When to buy and when to sell. Graham advises the defensive investor to invest periodically and automatically, a method now known as dollar-cost averaging. By investing a fixed amount at regular intervals, for example, monthly, you buy more shares when prices are low and fewer when they are high, reducing the impact of volatility.
As for selling, he suggests doing so only if the stock no longer meets the 6 safety criteria, or if your allocation between stocks and bonds has drifted too far from the desired range. The goal is to minimize emotional decisions. 8. The psychology of the defensive investor. Perhaps the most profound lesson in this chapter is psychological. The defensive investor must learn emotional discipline, the ability to ignore market noise, resist herd behavior, and stick to the plan. When markets fall, the speculator panics. The defensive investor smiles and continues buying at cheaper prices. When markets boom, the speculator grows greedy. The defensive investor stays calm, content with his balanced returns. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. This calm temperament is the defensive investor's greatest asset. 9. Practical steps to apply Chapter 14. Here's how to apply Graham's principles today. Diversify broadly. Own 10 to 30 high-quality companies or use index funds to spread risk automatically. Favor financial strength. Stick to companies with strong balance sheets and stable earnings histories. Insist on a margin of safety. Buy only when valuations are reasonable. Avoid overpriced hype stocks. Balance stocks and bonds. Adjust the ratio depending on market conditions and personal comfort with risk. Stay disciplined and consistent. Invest regularly and hold long-term, ignoring daily market fluctuations. Avoid speculation. Don't chase tips, predictions, or sudden trends. Focus on fundamentals. 10. The essence of the defensive investor. To summarize, Graham's advice for the defensive investor can be boiled down to 3 words: simplicity, safety, and self-control. He doesn't ask you to outsmart Wall Street, just to avoid its mistakes. He doesn't ask you to predict the future, just to protect yourself from uncertainty. He doesn't promise instant wealth, only steady, sustainable financial independence. If you follow sound principles, you are virtually guaranteed satisfactory results. If you violate them, no one can save you. Closing thought. This chapter is the blueprint for a lifetime of calm and confident investing. It's not glamorous, but it works. It's not fast, but it's reliable. The defensive investor's quiet approach, grounded in logic and patience, remains one of the surest ways to grow wealth and peace of mind simultaneously.
Chapter 15. Stock Selection for the Enterprising Investor. In Chapter 15, Benjamin Graham shifts his focus from the defensive investor, who prioritizes safety and minimal effort, to the enterprising investor, someone willing to put in extra work, research, and discipline to potentially earn higher than average returns. But before diving into methods and formulas, Graham offers a word of caution. The enterprising investor must expect to put in a good deal of time and care in his work. Otherwise, he is better off being a defensive investor. In other words, to outperform the market, you must deserve to outperform the market through effort, patience, and rationality. This chapter outlines practical strategies that help the enterprising investor find value where others overlook it. 1. The nature of the enterprising investor. The enterprising investor's mindset is proactive but grounded. Unlike the speculator who gambles on market trends or hot tips, the enterprising investor seeks undervalued opportunities through careful analysis. Their objective isn't to take wild risks, but to find bargains, companies temporarily mispriced by the market. Graham explains, the enterprising investor aims not to beat the market every time, but to gain a margin of safety in every investment. He warns that most investors think they are enterprising, but few are willing to put in the emotional and analytical work required. 2. The categories of enterprising investments. Graham outlines several categories that an enterprising investor can explore. Undervalued common stocks. Stocks selling well below their intrinsic value due to temporary setbacks or market pessimism. These might include companies with strong assets but low earnings, or firms in unpopular industries. Relatively unpopular large companies. When once famous companies fall out of favor, their stock prices often decline too far. The enterprising investor can capitalize on this overreaction. For example, suppose a major auto manufacturer faces a short-term scandal, and its stock drops 40%. A defensive investor avoids it. An enterprising investor analyzes its fundamentals and may recognize a long-term opportunity. Special situations or workouts. These include mergers, acquisitions, liquidations, or reorganizations, events that temporarily misprice a company's value. While riskier, they can yield significant returns if handled with precision and insight. Bargain issues or net stocks. These are stocks selling for less than the company's net current asset value, meaning that even if the business shut down tomorrow, shareholders could theoretically recover more than the current share price. Though rare today, such opportunities occasionally appear in small, neglected firms. 3. How to identify bargains. The core skill of an enterprising investor is detecting undervaluation. Graham offers several signs that a stock may be undervalued. Its P/E ratio is significantly lower than the market average. Its price-to-book ratio is less than 1. The company's dividend yield is higher than average. The business has temporary problems, not structural ones. For example, a manufacturing company might see a drop in profit due to short-term commodity prices. Once costs stabilize, earnings may rebound and the stock price will follow. Graham calls this the art of buying a dollar for 50 cents. 4. The case for patience and discipline. One of the key lessons in this chapter is that timing the market is impossible, but time in the market is essential. Enterprising investors don't chase momentum or short-term news. They wait for the right price. The intelligent investor is a realist who sells to optimists and buys from pessimists. When everyone is fearful during recessions, market crashes, or negative headlines, true bargains appear. When everyone is greedy, bargains disappear. This contrarian mindset requires courage, patience, and conviction. 5. How to analyze a company. Graham encourages enterprising investors to perform basic but disciplined analysis on each company. He recommends looking at earnings record, at least 10 years of profitability, financial position, reasonable debt levels and liquidity, dividend record, consistent payments show stability, earnings trend, moderate and steady growth, not rapid or speculative jumps, management quality, conservative, transparent, and shareholder-oriented. He also warns against overanalyzing to justify emotional decisions. The investor's chief problem, and even his worst enemy, may likely be himself. Thus, research must be guided by reason, not emotion.
6. Mistakes enterprising investors must avoid. Graham lists several traps that destroy returns for overconfident investors. Overtrading, constantly buying and selling based on market noise. Chasing growth stocks, paying high prices for companies with popular stories but fragile fundamentals. Ignoring diversification, concentrating too heavily in one industry or company. Speculating with borrowed money. Leverage magnifies losses. Neglecting patience, selling undervalued stocks too early. To achieve satisfactory results is easier than most people realize. To achieve superior results is harder than it looks. In short, stay grounded. Even enterprising investing should remain conservative in principle. 7. Practical examples. Applying Graham's strategy today. Let's bring these principles into a modern context. Imagine you identify a company like a steel manufacturer whose stock price has fallen due to a global slowdown. The firm has strong cash reserves, manageable debt, and the decade of profits. While the crowd avoids it, you recognize a margin of safety. The market's fear has undervalued the company. By buying now and holding through recovery, you could double your money when conditions stabilize. Similarly, during market crises like 2008 or 2020, investors who followed Graham's principles, buying undervalued, financially solid firms, saw huge long-term gains when the market recovered. 8. The importance of a margin of safety.
The margin of safety is Graham's most famous principle, the cornerstone of every intelligent investment. It means never paying full price for a company's value. Always leave room for error, uncertainty, and volatility. The function of the margin of safety is, in essence, that of rendering unnecessary an accurate estimate of the future. For example, if you estimate a company's intrinsic value at $100 per share, buy it only if it's priced below $70. That cushion protects you from mistakes in judgment or unexpected downturns. In the long run, investors who consistently apply this principle are those who survive and prosper. 9. Balancing risk and reward. The enterprising investor accepts moderate risk, but only when compensated by substantial potential reward. Graham suggests keeping a balanced portfolio, a core portion in safe, diversified stocks or index funds for stability, a smaller portion for special situations or undervalued plays for growth. This dual approach ensures both security and opportunity, the essence of intelligent investing. 10. The enterprising investor's mindset. Finally, Graham emphasizes that successful investing is 80% psychology and 20% analysis. The enterprising investor must cultivate independence. Think for yourself, not with the herd. Discipline. Stick to facts, not feelings. Patience. Wait for opportunities. Don't force them. Humility. Accept mistakes. Learn and adapt. These traits are what separate the investor from the speculator, not access to data or fancy models. In the end, what counts is not intelligence, but character. 11. Practical tips to apply Chapter 15. Screen for undervalued stocks. Look for low PE ratios, low PB ratios, and strong balance sheets. Favor out-of-favor industries. Temporary downturns often create long-term bargains. Apply a margin of safety. Buy below intrinsic value. Never chase prices. Diversify moderately. Hold 10 to 20 well-chosen stocks from various sectors. Think long-term. Hold patiently until the market recognizes the value. Stay emotionally detached. Your greatest asset is self-control, not market prediction. 12. Final thought. Chapter 15 stands as a manual for the intelligent, active investor. It's not a call to gamble or chase quick profits. It's an invitation to think deeply, act patiently, and invest with logic. The enterprising investor's advantage isn't insider information or luck. It's discipline and independent thought. To be an intelligent investor is to be patient, analytical, and emotionally stable. By following Graham's approach, the enterprising investor learns to profit not from speculation but from human nature itself, buying when others are fearful and selling when they are greedy.
Chapter 16. Convertible Issues and Warrants. In Chapter 16, Benjamin Graham tackles a topic that often confuses investors: convertible issues and warrants. These hybrid financial instruments promise both the safety of bonds and the potential of stocks. But Graham, ever the realist, warns that these securities often favor the issuer more than the investor. They tempt investors with dreams of high returns, but beneath the surface, they usually carry risks that are easy to overlook. This chapter teaches us how to see through the illusion of double advantage and evaluate convertibles and warrants with a rational, disciplined mind. Number 1. What are convertible issues? A convertible issue is a type of bond or preferred stock that can be converted into common stock of the same company, usually at a predetermined price. For example, suppose a company issues a bond worth $1,000 with an annual interest rate of 5%, convertible to 50 shares of its stock. If the stock price rises above $20, investors may convert their bonds to profit from the increase. At first glance, this seems ideal. If the stock goes up, you gain. If not, you still receive interest. But Graham warns, the idea of something for nothing, of having your cake and eating it too, has always been alluring but seldom sound. Number 2, the problem with convertibles. Convertibles are usually overvalued because investors are drawn to their apparent safety and upside potential. Companies know this and therefore issue convertibles to raise capital on favorable terms. Let's unpack why this can be problematic. Lower income. Convertibles typically offer a lower interest rate or dividend yield than standard bonds because of the conversion privilege. Limited upside. If the company's stock rises, conversion profits are often smaller than those from owning the common stock directly. Increased risk. If the company's fortunes decline, the convertible's bond protection becomes weak.
its price often falls alongside the stock because investors lose faith in the conversion feature. Essentially, the investor gives up part of the bond's safety without fully gaining stock-like potential. Convertibles are more often a compromise that fails to satisfy either the investor's need for safety or his desire for gain. Number 3, why companies love convertibles. From the company's perspective, convertibles are a clever financial tool. They allow cheaper borrowing, since the conversion feature attracts investors despite lower yields, delay dilution of shares. New stock isn't issued unless the price rises. Appeal to optimistic investors who believe in the company's growth story. Graham points out that when a company issues convertibles, it's often a signal that management is taking advantage of favorable market psychology, not offering a good deal for investors. In most cases, the investor in convertibles is paying handsomely for a mere possibility of conversion. Number 4, the illusion of safety. Many investors buy convertibles thinking, even if the stock doesn't go up, I still have a bond. But Graham cautions that in reality, this safety is weaker than it appears. Why? Because the bondholder's protection erodes once the company's performance weakens. The market tends to price the convertible more like a stock than a bond. For example, a convertible bond may fall 40 to 50% in price during a bear market, similar to the stock, even though it technically has a fixed income component. Thus, Graham advises, don't count on the bond floor to save you. The market seldom honors it when fear sets in. And number 5, warrants, the other trap. A warrant is a long-term option that allows investors to buy shares at a fixed price in the future. For example, a warrant might allow you to buy a company's stock at $50 per share anytime in the next 10 years. At first, this seems like a great opportunity. If the stock soars, you can buy cheap. But Graham calls warrants the creation of speculators, not investors. They are highly volatile, often overpriced, and have no intrinsic value until exercised. Moreover, companies issue warrants when they want to make their offerings look attractive, not necessarily when the investment is wise. Warrants are an open invitation to speculation, and speculation masquerading as investment is the investor's worst enemy.
6. The psychological trap. Convertibles and warrants play on investor psychology. They appeal to two powerful emotions: greed, the hope of huge profits if the stock rises, and fear, the comfort of bond protection if it falls. This emotional appeal makes them market favorites during bullish periods. However, when reality sets in, most investors find they've paid too much for too little. Graham's advice is simple. If you want to speculate, do so with your eyes open and with a small portion of your capital. Do not disguise speculation as investment. 7. When convertibles can be acceptable. Graham isn't entirely against convertibles. He acknowledges that in certain rare situations, they can be reasonable investments, particularly when the conversion price is near or below the stock's current market price, the bond's yield is comparable to non-convertible issues, the company has a strong financial condition and stable earnings, the investor is willing to analyze and monitor the situation carefully. In short, a convertible might make sense if it offers real bond-like income with a bonus option, not just a flashy promise. 8. The margin of safety still applies. Even when dealing with hybrid securities, Graham's golden rule remains. Always insist upon a margin of safety. This means don't buy convertibles at inflated prices. Ensure that even without conversion, the bond provides a satisfactory yield. Consider the worst-case scenario. If conversion never happens, will the return still be acceptable? If not, you're speculating, not investing. 9. How to evaluate convertibles. Graham provides a rational checklist. Step 1. Analyze the underlying company. Is it financially strong, consistently profitable, growing modestly and sustainably? Step 2. Evaluate the bond terms. Is the coupon rate reasonable? How long until maturity? Is the company likely to redeem it early? Step 3. Assess the conversion terms. What is the conversion price? How far is the stock from that level? Step 4. Compare alternatives.
Would you be better off buying the company's stock directly or a plain bond from another solid firm? If the convertible only offers excitement, not real value, walk away. 10. Modern-day application. In today's markets, convertibles and warrants are still popular, especially with tech firms and startups. However, Graham's warnings are more relevant than ever. During boom periods, many investors buy these instruments believing they're getting in on the next big thing. But when markets correct, they discover that the bond floor disappears and the conversion option becomes worthless. A modern example can be seen in convertible bonds issued by fast-growing tech companies that later saw stock price collapse. The bonds fell sharply too, proving Graham's point. The illusion of safety is just that, an illusion. 11. The core lesson. The essence of Chapter 16 is simple yet profound. Don't mix excitement with investment. Convertibles and warrants are designed to sound attractive, safe income plus upside, but in most cases, they deliver neither true safety nor meaningful gain. Graham's philosophy is to invest where value is real and measurable, not where promises are vague and emotional. Quote, "In investing, what is comfortable is rarely profitable." 12. Practical takeaways. Don't be lured by complex or hybrid securities. Always analyze what you're truly buying: a bond, a stock, or a speculation. Focus on companies with strong fundamentals, not fancy financing. Avoid overpaying for conversion privileges or options. Keep your portfolio simple and understandable. As Warren Buffett, Graham's student, often says, quote, "Never invest in a business you cannot understand." Final thought. Chapter 16 reminds us that simplicity is power in investing. The intelligent investor doesn't chase clever instruments. He builds wealth through clarity, discipline, and patience. Convertibles and warrants may glitter, but Graham teaches us to look beyond the shine, to the structure, risk, and true value beneath. Quote, "In investing, what is comfortable is rarely profitable." By staying focused on fundamentals and avoiding seductive traps, you remain aligned with the timeless principles of intelligent investing.
Chapter 17. 4 extremely instructive case histories. In Chapter 17 of The Intelligent Investor, Benjamin Graham shifts gears from theory to real-world application. He introduces 4 detailed case studies to demonstrate how his investment principles work when tested against reality. These stories show what happens when investors abandon discipline, fall prey to market euphoria, or ignore fundamentals, and how rational analysis can protect and reward those who stay grounded. Through these examples, Graham brings to life his most important message. The market is a pendulum that forever swings between unsustainable optimism and unjustified pessimism. The intelligent investor is calm and patient, profiting from both. Let's explore these 4 instructive case histories and the timeless lessons they carry for every modern investor. Case 1. The Power of Patience. Northern Pipeline Company. Our first case begins in the early 20th century with the Northern Pipeline Company, an oil pipeline firm. On the surface, it looked like a sleepy business, slow-moving, not very exciting. But beneath that calm exterior lay an incredible secret. Benjamin Graham discovered that Northern Pipeline held substantial investments in U.S. government bonds, assets that were completely ignored by the market. The stock was trading far below the company's true value. In fact, its market price was less than the cash and bonds it owned. So what did Graham do? He analyzed the balance sheet, realized the intrinsic value was far greater than the market price, and bought shares heavily. He even pushed for the company to distribute those unused assets to shareholders. Eventually, after some resistance, the company did just that, and Graham earned a handsome profit. Idea 1. The market can stay ignorant longer than you expect, but value will always reveal itself. Patience and analytical discipline paid off. Graham didn't buy because of excitement or trends. He bought because the numbers made sense. Practical tip.
Always check the balance sheet of a company, not just its stock chart. Sometimes, hidden value, like excess cash, property, or investments, makes a company far more valuable than its share price suggests. Case 2. The Traps of Overconfidence, Penn Central Company. The second story is a powerful warning. It's about Penn Central, once America's largest railroad and transportation company. In the 1960s, Penn Central was seen as a blue-chip investment, solid, safe, and reliable. Analysts praised its management, and investors assumed that a company of this size could never fail. But beneath the glamorous reports and reassuring statements, the company's financial position was deteriorating. It was borrowing heavily, making poor acquisitions, and masking its weaknesses through clever accounting. In 1970, Penn Central suddenly collapsed into bankruptcy, one of the largest corporate failures in U.S. history. Idea 2. Prestige and size do not equal safety. Even a massive, well-known company can crumble if its fundamentals are weak. Graham reminds us that the intelligent investor must look past reputation and focus on real data, debt levels, cash flow, and profitability. Practical tip: avoid assuming a company is safe just because it's famous or long established. Always examine the financial health and business model stability before investing. Ask, would this business still survive a recession or industry shock? Case 3. The Dangers of Speculation, Ling Temco Vout, or LTV. The third case is about Ling Temco Vout, or LTV, a company that epitomized the excesses of the 1960s stock market boom. LTV grew rapidly by acquiring dozens of unrelated businesses, everything from electronics to steel to sporting goods. It was a classic conglomerate, and investors adored it. The company's stock price soared as Wall Street celebrated its supposed genius. But the truth was grim. LTV's empire was built on debt and hype, not on real profitability. When the market corrected, LTV's illusion collapsed, and its stock price plummeted more than 90%. Idea 3. Speculation disguised as growth investing is the investor's greatest danger. Graham's analysis showed that LTV never justified its inflated price. The company's acquisitions added complexity, not value. Investors bought dreams, not data. Those who do not distinguish between investment and speculation are bound to suffer for it. Practical tip: before buying a hot growth stock, ask, are profits rising as fast as the hype? How much debt does the company carry? What would this business be worth if market optimism vanished tomorrow?
Case 4. The Promise and Pitfall of Turnarounds, NVF and Sharon Steel. The fourth story explores turnaround investing through the companies NVF and Sharon Steel, both controlled by the aggressive businessman Victor Posner. Posner gained fame for buying struggling companies cheaply, restructuring them, and trying to make them profitable again. On paper, this looked brilliant, a savvy businessman rescuing dying firms. But Graham examined these companies closely and found serious issues. Their accounting practices were questionable. Their balance sheets were loaded with debt. Their recovery stories were overly optimistic. While many investors rushed in, hoping to profit from a comeback, most ended up losing money when the turnaround never materialized. Lesson 4. Not all turnarounds succeed, and many are just traps. Graham explains that buying weak companies on the hope of recovery is speculative. A genuine turnaround opportunity must have strong assets, good management, and realistic recovery prospects. Turnarounds rarely turn. Practical tip: when evaluating turnaround stocks, focus on tangible assets and cash flow, not promises. Avoid managements that rely on accounting gimmicks or over-promises. Prefer companies that are improving quietly, not those shouting about it. Timeless insights from all four cases. From these stories, Graham distills several unchanging truths. 1. Value is objective, not emotional. Real worth comes from assets, earnings, and stability, not from hope or hype. 2. Reputation is not protection. Even admired companies can fail. Always verify their financial integrity. 3. Speculation breeds ruin. When prices are driven by excitement instead of evidence, collapse is inevitable. 4. Patience pays. Markets swing wildly in the short term, but over time, intrinsic value asserts itself. Modern-day application. These case histories might seem old, but their lessons are eerily relevant today. Modern investors face similar traps. Tech startups valued on hype, too big to fail corporations, and over-leveraged conglomerates. Each time the market cycle repeats, human behavior stays the same. Greed replaces caution. Optimism blinds reason. And history repeats itself. Graham's examples are reminders that the intelligent investor's weapon is discipline, not prediction. To be an intelligent investor, one must be self-reliant and emotionally balanced. Practical applications for today's investor. 1. Always analyze balance sheets, especially cash, debt, and assets. 2. Avoid companies with rapid acquisitions or unclear focus. 3. Be cautious of turnarounds and overhyped stocks. 4. Seek companies trading below intrinsic value. 5. Stay patient. Value reveals itself over time. Remember, the intelligent investor's success is built on reason, not reaction. Closing reflection. Through these 4 case studies, Benjamin Graham demonstrates that investment intelligence is not about predicting the future, it's about understanding the present clearly. When you apply logic, discipline, and skepticism, you protect yourself from the traps of speculation and greed. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. These stories prove that truth, showing how reality eventually rewards rational investors and punishes emotional ones.
Chapter 18. A comparison of 8 pairs of companies. In Chapter 18, Benjamin Graham concludes The Intelligent Investor by presenting an analytical masterpiece, a comparison of 8 pairs of companies designed to show how investors often make irrational choices when guided by emotion, hype, or blind faith in growth stories. Through these comparisons, Graham once again demonstrates that rational analysis, not popularity, defines an intelligent investment. He reminds us that Wall Street often assigns wildly different valuations to companies with similar fundamentals, not because one is truly superior, but because investors chase fashion instead of value. The intelligent investor realizes that stocks become riskier, not safer, as their prices rise. This chapter brings everything full circle, combining Graham's central lessons about value, patience, and discipline, while exposing the traps of market psychology. Let's explore these 8 comparisons and the timeless lessons they hold. Pair 1. General Electric versus Westinghouse. Both General Electric and Westinghouse were dominant industrial giants, producing similar goods and serving similar markets. Yet in the late 1960s, GE's stock traded at twice the price-to-earnings ratio of Westinghouse. Why? Because investors viewed GE as more innovative, modern, and dynamic, while Westinghouse seemed old-fashioned. However, their long-term earnings and stability were remarkably similar. GE's popularity premium wasn't based on tangible value, but on perception. Lesson 1. Popularity creates price distortions. Investors often overpay for favorite companies. The intelligent investor resists such hype and looks for value in the overlooked. Practical tip. When comparing 2 companies, ignore the brand's glamour. Focus on earnings power, debt levels, and historical performance. The best opportunities are often those that look boring. Pair 2. Sears versus Montgomery Ward. Both were retail giants in their time. Sears had a slightly better track record, but by the late 1960s, its stock traded 3 times higher than Montgomery Ward's relative to earnings. The lesson? Even small differences in reputation can cause massive valuation gaps. Over time, however, Sears's performance stagnated, and investors who bought at inflated prices suffered. Lesson 2. A great company is not always a great investment. Even well-managed firms can be poor investments if their stock price already reflects perfection. Price is what you pay. Value is what you get. Practical tip: don't pay too much for excellence. Look for undervalued good companies, not overpriced great ones. Pair 3. Chrysler versus General Motors. During the 1960s, General Motors was the undisputed industry leader, while Chrysler was seen as the underdog. GM stock was valued far higher, even though Chrysler was showing strong profitability and paying generous dividends. Later, when the auto market cooled, GM stock fell sharply, while Chrysler's, being cheaper, offered a cushion. Lesson 3. Undervalued competitors often outperform the dominant players. Graham shows us that smaller or less admired companies sometimes offer better risk-adjusted returns than giants, especially when the latter's stocks are overpriced. Practical tip: don't chase the leader, look for value in the shadow of giants. Often that's where the bargains lie. Pair 4. RCA versus Zenith. RCA was a media and electronics powerhouse, known for its innovation and strong public image. Zenith, a smaller electronics maker, was profitable but much less famous. Despite similar financial performance, RCA's shares traded at a premium multiple, fueled by investor fascination with its growth story. In the end, Zenith's steady performance made it a better long-term investment. Lesson 4. Fame and future potential are not substitutes for earnings reality. When everyone believes in a company's boundless future, prices detach from reality and risk soars. Practical tip: be cautious of glamour stocks. If the media can't stop talking about it, chances are it's already overpriced.
Pair 5. IBM versus Texas Instruments. IBM and Texas Instruments both dominated technology in their own ways. Investors were euphoric about TI's explosive growth in the semiconductor business, giving it a sky-high valuation. But IBM, though slower growing, had stable earnings and deep competitive advantages. Over time, IBM's steadiness rewarded investors more reliably. Lesson 5. Sustainable performance beats short-term excitement. Markets often overvalue high-growth companies that can't maintain their momentum. Practical tip: favor durable business models over trendy ones. Ask, will this company still be profitable 10 or 20 years from now? Pair 6. Merck versus Smith, Kline & French. Two leading pharmaceutical companies with similar profits and research pipelines. Yet one was priced nearly twice as high simply because investors believed it had better prospects. History later showed both had comparable results. The cheaper stock offered a superior return. Lesson 6. Forecasting prospects is a dangerous game. Graham warns against paying for what might happen in the future. Even experts can't reliably predict breakthroughs or industry changes. Practical tip: buy based on present fundamentals, not future fantasies. The future should be a bonus, not the basis of your investment. Pair 8. American Telephone and Telegraph, AT&T, versus General Dynamics. AT&T was the classic defensive stock, stable, dividend-paying, and low risk. General Dynamics, on the other hand, was a defense contractor with volatile earnings tied to government contracts. Yet both offered similar long-term returns. The difference lay in risk tolerance. Graham explains that defensive investors might choose stability, while enterprising investors might accept volatility for potentially higher returns, as long as they understand the trade-off. Lesson 7.
There's no one-size-fits-all investment. Your choice must align with your temperament. A calm mind is more valuable than an aggressive portfolio. Practical tip: define your investor type. If you prefer safety and sleep well, choose defensive stocks. If you can handle volatility, selectively explore enterprising opportunities. Pair 8. Coca-Cola versus PepsiCo. Finally, Graham compares two household names, Coca-Cola and PepsiCo. Their operations, brands, and growth were strikingly similar. However, Coca-Cola's prestige and stronger brand image gave it a much higher valuation, while Pepsi shares were cheaper despite comparable earnings. Over time, both delivered excellent returns, but the investor who bought Pepsi at a lower price enjoyed a superior margin of safety and a better yield. Lesson 8. Even among equals, value lies in the less admired option. You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Practical tip: when faced with two strong companies, choose the undervalued one. In the long run, value always wins over popularity. Graham's final message: discipline over emotion. After walking us through these 8 comparisons, Graham leaves us with a powerful conclusion. The market often misprices stocks, not because of new information, but because of human behavior. Investors get excited by stories, trends, and names. The intelligent investor, however, ignores the noise and stays anchored to data. Be analytical, not emotional. Seek value, not popularity. Buy when others are fearful, sell when others are greedy. Practical takeaways for modern investors: compare before you buy. Always evaluate competitors to understand true value. Avoid hype-driven sectors. The crowd's favorite is rarely the best deal. Think in decades, not days. The intelligent investor measures success in long-term compounding. Keep your margin of safety. A discounted price is your best protection. Know yourself. Match your strategy to your temperament. Closing reflection. In this final chapter, Benjamin Graham gives us a mirror, showing how our biases shape the way we see value. He proves that the difference between success and failure in investing rarely comes from knowledge alone. It comes from emotional control and disciplined thinking. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. The intelligent investor is patient, analytical, and unshakable, thriving not by outsmarting the market, but by outlasting it.
Final reflection: the timeless wisdom of the intelligent investor. This isn't just a book about money. It's a philosophy, a lifelong discipline, and a mirror reflecting how our emotions, habits, and patience determine our financial destiny. Since its first publication in 1949, this classic has changed the mindset of countless investors, including Warren Buffett, who famously called it by far the best book on investing ever written. Now, as we conclude, let's revisit the most powerful lessons from Graham's philosophy and how they can guide you toward a lifetime of intelligent investing. Lesson 1. The market is your servant, not your master. Graham personifies the market as Mr. Market, a moody business partner who shows up every day with new price offers. Some days he's euphoric, offering absurdly high prices. Other days he's depressed, selling for far less than value. The intelligent investor doesn't get carried away by Mr. Market's moods. He uses the market's irrationality to his advantage, buying when it's fearful and selling when it's greedy. The investor's chief problem, and even his worst enemy, is likely to be himself. Practical insight: stop reacting to daily price swings. Use the market, but never let it use you. Patience, not panic, is your greatest edge. Lesson 2. The margin of safety, your shield against uncertainty.
At the heart of Graham's philosophy is one concept: the margin of safety. No matter how strong a company appears, unexpected problems, economic shifts, management mistakes, or market downturns can happen. By purchasing well below a stock's intrinsic value, you build a cushion against loss. The essence of investment management is the management of risks, not the management of returns. Practical insight. Always ask, if things go wrong, will I still be protected? Only buy when the odds are in your favor. It's better to miss an opportunity than to lose capital chasing one. Lesson 3. Be a true investor, not a speculator. Speculators chase short-term trends. They trade on predictions, rumors, or excitement. Investors, on the other hand, analyze businesses. They look for enduring value and hold with conviction. Graham warns that speculation isn't inherently evil, but it's dangerous when you confuse it with investing. Practical insight. If you're buying because the stock is popular, that's speculation. If you're buying because it's undervalued, based on earnings, assets, and stability, that's investment. Investing is most intelligent when it is most businesslike. Lesson 4. Know which type of investor you are. Graham divides investors into two groups. The defensive investor seeks safety and steady returns with minimal effort. The enterprising investor dedicates time and energy to finding undervalued opportunities. Both can succeed, but only if they stay disciplined within their chosen style. Practical insight. You don't need to beat the market to achieve financial success. Consistency, not brilliance, builds wealth. Know your temperament and invest accordingly. Lesson 5. Value over growth. Graham challenges the obsession with growth stocks. He reminds us that growth is valuable only when you don't overpay for it. A mediocre company bought at a low price can outperform a great company bought at an inflated one. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. Practical insight. Pay attention to the price you pay. Even the best business can be a poor investment if you overpay it for it.
Lesson 6. Emotional discipline is your true advantage. Markets rise and fall, but the intelligent investor remains calm. Graham's philosophy is as much psychological as financial. He teaches that the ability to stay rational when others panic is the single most important trait for success. To be an investor, you must be a believer in a better tomorrow. Practical insight. Don't let fear or greed control your decisions. Stay grounded in facts, analysis, and long-term conviction. Master yourself, and you'll master the market. Lesson 7. Long-term thinking wins. Every major lesson in The Intelligent Investor points towards one truth. Time is the investor's greatest ally. Compounding rewards patience. While speculators chase fast profits, intelligent investors build wealth through slow, steady accumulation. The real money in investing will have to be made, as most of it has been in the past, not out of buying and selling, but of owning and holding securities. Practical insight. Think in decades, not days. Buy quality assets, reinvest your dividends, and let time do the heavy lifting. Lesson 8. Independent thinking is the mark of wisdom. Perhaps the most powerful message Graham leaves us with is intellectual independence. You must learn to trust your own analysis, even when the crowd disagrees. You are right because your facts and reasoning are right, not because others agree with you. The intelligent investor stands firm amid noise, hype, and panic. Practical insight.
Always do your own research. If your logic is sound and your data is solid, the market will eventually recognize the truth. Timeless takeaways from The Intelligent Investor. Be patient. Time and compounding are your greatest allies. Be disciplined. Never follow the crowd. Follow your analysis. Be safe. Always maintain a margin of safety. Be calm. Market volatility is normal. Emotional volatility is not. Be wise. Seek value, not excitement. Modern application. Investing in the age of information. In today's world of cryptocurrencies, AI-driven trading, and meme stocks, Graham's principles are more relevant than ever. When markets move at lightning speed, discipline and value thinking become rare superpowers. Those who master emotional control, critical thinking, and long-term perspective will thrive, regardless of the noise. Final reflection. Benjamin Graham's wisdom reminds us that wealth is not built through luck or timing, but through clarity, patience, and discipline. He doesn't just teach us how to invest, he teaches us how to think. In the short run, the market is a voting machine. In the long run, it is a weighing machine. The intelligent investor knows success is not about predicting the future, it's about preparing for it intelligently.
That was The Intelligent Investor, complete. If this changed the way you think about money, subscribe and leave a like. It takes 1 second. The next video is on your screen right now. Your financial education continues.